Brad Smith alongside Alexandra Canal this morning. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Yeah, stock futures slipping a bit this morning as Wall Street awaits the start of the Fed's two-day June policy meeting. Treasury yields are also moving to the downside. So let's get to it with the three things you need to know this Tuesday morning as you prep for the trading day. Yahoo Finance's Madison Mills, Jared Blickery, and Jennifer Schomburger have more.
That's right, a mild reaction from investors to Apple's Worldwide Developers Conference on Monday after new features did not meet high expectations. Dubbed Apple Intelligence, the iPhone maker's new AI features include an upgraded version of Siri and a deal with OpenAI to harness ChatGPT for use on the iPhone, iPad, and Mac products.
Introducing Apple Intelligence, the new personal intelligence system that makes your most personal products even more useful and delightful.
Shares of Apple mostly flat pre-market, a little bit of pressure there after closing down 2% following Monday's announcement.
And Elon Musk has privacy concerns about Apple's use of OpenAI on its devices, and he's making it known. Musk posting on X, formerly Twitter, Monday night, quote, "If Apple integrates the OpenAI at the OS level, then Apple devices will be banned at my companies. That is an unacceptable security violation." Apple says Siri voice assistant will be able to tap into ChatGPT when helpful. The users will be asked before any questions are sent, and privacy protections are built in for users who can access the chatbot. Musk co-founded OpenAI back in 2015, but stepped down from the board in 2018 and has since grown critical of co-founder and CEO Sam Altman, alleging OpenAI has gotten off its mission to develop AI for the benefit of humanity.
And the Fed kicks off its two-day policy meeting here in Washington this morning. The central bank widely expected to hold rates steady in the range of 5.25% to 5.5%, as it has done since July of 2023. But all eyes will be on the Fed's so-called dot plot, which will give investors insight into just how many rate cuts the Fed is looking at this year. The dot plot is released 4 times per year, and investors expect that the Fed will scale back the number of rate cuts to 2 or 1 from 3 previously projected. Wall Street pricing in a less than 50% chance for the first rate cut in September.
Let's get right to our top story this morning. It is Apple. After almost 2 years of sitting out of the artificial intelligence frenzy, Apple finally made its big splash. The company announcing a slew of AI tools coming to its platform. So let's get to Yahoo Finance's Madison Mills, who has the ultimate guide for all things Apple this morning. Hey, Maddie.
Hey, Brad, it's definitely all about Apple, as you said. Here are 3 things that you need to know from Apple's big announcement. First of all, the AI announcement, it's getting personal. The theme was AI for the rest of us. But what does that mean, right? Well, it's going to prioritize messages, notifications, and offer proofreading writing tools. You can suggest a theme, a tone change, for example. That'll also result in a major upgrade for Siri, Apple's virtual assistant. Apple calling this the year of the start of a new era for Siri. Now, number 2, all of this is going to be made possible with Apple's new partnership with OpenAI. That is going to allow the company to integrate ChatGPT into the iPhone via Siri, which will lead to all kinds of AI-empowered features. For example, it'll allow users to integrate AI into Siri in the Photos app. You could take a picture of your living room and get decor advice thanks to AI. Now, the company did promise that it will ask user permission every time ChatGPT is involved, which is going to be critical for number 3 here, the key issue, privacy. It's all about privacy. That was definitely a theme throughout the announcement. Apple positioned the new AI features as privacy-oriented. The company says its architecture enables it to be aware of your personal data without outright collecting it. But guys, investors are for now not seeing a lot of their expectations met off of that news. Those high Wall Street expectations for the announcements appear to have been missed, with shares under pressure this morning, looking like they're at the flat line here after closing down over 2% yesterday.
Thanks, Maddie. Well, despite the lackluster investor response, our next guest is feeling bullish, upgrading the tech giant from neutral to buy and raising his price target from $200 a share to $230. Gil Lauria, D.A. Davidson Managing Director, joins us now with more. Gil, let's start with the share price action. We saw shares close down about 2% yesterday. We're pretty muted right now. Is this a sell the news event, or what do you think was missing here for investors?
Well, I think there was a lot of noise. A lot of people have very strong opinions about Apple and its products, and were maybe had expectations for something that would blow them away and be unprecedented. That's not what Apple needed to do. Apple, what they did yesterday was exactly what you described. They took all this technology that's been developed over the last year and a half and integrated and personalized it into their platform. What that means is that a lot of this functionality that right now we have to use away from our other applications. We have to go outside of our application to go to ChatGPT or Perplexity or Claude, will now be seamlessly integrated into the applications we already use. That means we're going to go from hundreds of millions of people using generative AI to billions of people as soon as this is introduced. And that's what's going to drive an iPhone upgrade cycle for the first time in 4 years. That's what's important here. A lot of noise, a lot of people with different expectations coming in. But if you look at the signal away from the noise, you realize that this is unprecedented capabilities that Apple is going to introduce, and it's going to integrate AI into everyday life.
Yeah, and I mean, even as we're thinking about the iPhone and what this new kind of super cycle is that could be driven because of generative AI being integrated into these consumer technology products, it also comes back to where this is going to create a new base run rate for services. How do you see that playing into the revenue model there?
That's right. The services business is already growing double digits because Apple can offer more and more things to its installed base. But that hasn't been enough for more than low single-digit growth the last couple of years. For Apple, the stock to work, growth has to accelerate from here. And the only way that happens is if iPhone sales accelerate. The last time that happened was iPhone 12. Why? Because they introduced 5G capabilities, which were compelling, and it wasn't backward compatible. The stock tripled around that introduction, and it's been practically flat for the last 3 years since then. Now we finally have something that's compelling. The functionality yesterday, when consumers have it in their hands, are going to be very excited about it. And it's not backward compatible. You have to have at least iPhone 15 Pro or newer in order for it to work. So as people buy new phones this holiday season, they're going to see this great functionality. They're going to show their friends and family, and the product upgrade cycle will happen over the next few months and quarters.
So, Gil, you see this driving the upgrade cycle. Where do you see that growth potentially topping out?
Well, we think that the consensus estimate was for iPhone to grow about 5% next year, with the year that includes the new iPhone 16. We actually increased our numbers to 10%. The growth for iPhone 12 was far higher than that. We think 10% reflects the fact that this is compelling and that you will need to use a new phone in order to be able to use all these AI capabilities that are now interwoven in the entire iPhone experience.
Gil, I mean, it's been a struggle bus for Apple so far this year. Just recently flipped into positive territory for the year to date. So is the trough behind us for Apple for right now that they finally announced some of what they're going to do with artificial intelligence?
It looks like it. The stock's been flat because there hasn't been revenue growth at Apple. Now that we think that this will allow Apple's overall growth to accelerate from the low single digits into the mid, maybe even high single digits over the next year or two, that's what can drive Apple's stock. At 25 times, it reflects little to no growth. We think it could go up to as much as 30 times earnings based on an accelerating growth rate. Again, reflective of the last time the stock worked, which is around the other meaningful iPhone upgrade cycle, iPhone 12.
And Gil, post this event, how do you think Apple is positioned when you compare it to some of the other competitors in the race for AI?
We think it took the lead because, again, everybody else has to try to fit their solutions elsewhere, or it really doesn't have access to the consumer and the consumer's information. Apple has our information. Some of the demos yesterday were as we were hoping for. When you can tell the device, hey, when is my dad landing? Where can I take him for lunch? Those are things that only Apple can do. And if they indeed roll out these capabilities this fall, which is what it's looking like this fall and winter season, which is what it's looking like, they're going to take the lead over everybody else, that all they can do is chatbots, image generation, summarization, some autocomplete. Apple's going to build all that into our experience and allow these experiences to leverage our own information in order to execute tasks as an agent. That puts them in the lead.
Gil Luria, D.A. Davidson, Managing Director. Gil, thanks so much for taking the time here today to talk all things Apple. We're going to be tracking up against some of your targets here.
Thank you.
Thanks. Well, there was one person in particular who wasn't too happy with Apple's announcement, Elon Musk, the Tesla CEO, making a post on X following Apple's WWDC, saying, quote, if Apple integrates OpenAI at the OS level, then Apple devices will be banned at my companies. That is an unacceptable security violation, he says, end quote there. You're seeing the post. Okay, there's a few things here. Number one, there's a broader move that we had seen towards bring your own device, or even for companies that would just said, all right, yeah, you can use your own phone or you can use your own laptop as long as we can install our own security software and patches on there and whatnot. Great. If he doesn't want to allow that, then he can just go about making a different purchase order, sweeping purchase order for the devices that a lot of companies had said, oh yeah, just use your own phone and we'll make sure that you've got all of the necessary apps and everything to make sure that we're secure and at least how you're operating with our information on there too.
Right, and Brad, let's take a step back and think about who we're talking about, right? Yeah. Elon Musk, he doesn't necessarily follow through with all his threats or all his promises. Also, he has some skin in the game here. He invested $6 billion into his own startup, XAI. That's going to take on OpenAI, ChatGPT, all those other competitors. He's also long feuded with Apple. Remember, Apple paused their ads on X following the endorsement of that anti-Semitic post. That
so don't endorse the post.
Exactly, last year. So there's some drama here already. All that being said, though, the privacy concerns, it is important. It's top of mind for consumers. Apple has said it's not going to be sharing data. It's not going to be training AI models and OpenAI with this data. We'll see, though, how it rolls out. But remember, this is Elon Musk, and you have to take what he says with a little bit of a grain of salt. Because in Silicon Valley, all his headquarters, everyone has this. Yeah. Everyone's coming in with an iPhone.
Right.
What do you're going to just lock up everyone's phones? I guess give your own phones to them. I don't get the long-term trajectory there.
Wealthy man's feels wrong too.
Yeah.
So that's what that is. Yeah.
Right. Well, the Fed is looking to kick off its two-day June policy meeting today. And although investors are pretty sure the Fed will hold rates steady, they're more focused on rate cut timing for the rest of the year. Here with more is Yahoo Finance's Jennifer Schomburger.
Good morning, Allie. That's right. The Federal Reserve kicks off its two-day policy meeting here in Washington, where it's widely expected to hold interest rates steady in the range of 5.25% to 5.5%. But all eyes will be on how the outlook for the rate path could change this year. Officials are expected to scale back the number of rate cuts to 2 or 1 from 3 previously projected. The new projection on Wednesday will come in the form of the so-called dot plot, a chart updated quarterly that shows each Fed official's projection about the direction of the Fed funds rate. Fed officials have warned in recent weeks they're looking to hold rates at current levels for longer after a scare that inflation may be stalling or reaccelerating in the first quarter. But the latest readings on inflation confirm prices are not accelerating, though they may be moving down slower than thought. We'll get a fresh reading on the Consumer Price Index for May Wednesday morning ahead of the decision. Fed Chair Powell has made very clear he thinks the Fed will need more than a quarter's worth of data to make a judgment on whether inflation is decisively falling toward the central bank's 2% target before cutting rates. Along with a new round of interest rate projections, Wednesday's meeting will bring fresh forecasts for inflation, the economy, and unemployment. Powell will also hold his regular press conference. Powell is expected to reiterate that rates will need to be held higher for longer to gain confidence that inflation is falling. Investors are looking to see whether Powell is encouraged at all by the latest readings on inflation, though that will be contingent on Wednesday morning's release of CPI. If CPI comes in as expected, falling 0.1% from the previous month, frankly, guys, that's not going to be enough to inspire confidence for the Fed. Back to you.
All right, Jennifer, I'll be sitting on the end of my ergonomic chair waiting for your email that the meeting has finally started there. Thanks so much, Jennifer. We're just getting started here on the Morning Brief. Investors feeling bullish on Eli Lilly after an FDA advisory board recommended its Alzheimer's drug. We've got some top trending tickers next. And our very own Pras Subramanian. If you're wondering where he is, want to know more, he's live on the ground at Deutsche Bank's Global Auto Industry Conference. Stay tuned for his conversation with Ford Vice Chair John Lawler later on this hour. Plus, Apple's announcements didn't do much for investors, but what do shareholders need to hear to change that? We'll discuss that during our 10 a.m. hour of Catalyst. All this and much more. You're watching Yahoo Finance. Time for some trending tickers. Eli Lilly shares moving higher after a panel of FDA advisors recommended the company's Alzheimer's drug, moving it one step closer to full FDA approval. Yahoo Finance's own Anjali Kamlani is here, and she's got the details. Hey, Anj.
Hey, Brad, that's right. Yesterday, we heard the unanimous vote from the FDA panel recommending that the FDA does go ahead and approve Eli Lilly's Alzheimer's drug donanemab. This drug has been facing a little bit of troubles. It did initially get rejected by the FDA for accelerated approval, but they went back and did the full study. They did see results of reduced decline in cognitive decline for patients by 35% over the 18-month period. This is a drug that's given through monthly IV infusions, just like the only drug on the market right now, which is Biogen and Eisai's Leqembi. So this would be competing in that space if approved. The study also looked at those who are 60 to 85-year-olds with mild dementia, a little bit more acute than what we saw with the Leqembi trial, but still within that mild dementia parameter. What we do know is that if it does get on the market, it would have a little bit more access. Analysts looking at the fact that it doesn't have the onerous sort of testing criteria that Leqembi does, which has slowed down its uptake in the market. So Eli Lilly well placed if the FDA does go ahead and approve this drug.
Thank you, Anjali. And more good news for NVIDIA. Oppenheimer raising its price target on the chip maker from $110 to $150 following its stock split. The analyst behind the call saying NVIDIA has several tailwinds driving, quote, sustained outsized top line growth. And Brad, this is one of several price target raises that we saw. Analysts at Goldman Sachs, also Argus Research, raising their respective price targets. Now, Argus saying that there's continued momentum that we could see for NVIDIA shares in 2025 after strong growth in 2024. So, you know, this is a stock that has just been on such a tear, up about 150% year to date. And now all of these analysts seeing a lot more room to run as they go beyond just a data center, but also opportunities in some of their other areas of the business.
Yeah, Evercore ISI, Goldman, they had been out with their notes early to start the weekend and last week as well here. So all of these things considered, a lot more affordability perhaps on the mindset of retail investors in NVIDIA, especially as it's been talked about by Goldman Sachs as the de facto AI play. More generally speaking now, it's more increasingly about where they can continue to see some of that chip demand, especially as the rest of the market is trying to move towards application. And what that means is the applications sitting on top of the models that then sit on top of the chips. And so if you've already got the chips, and the chips are going to continue to grow out. You think about the inferential technology that these companies were talking about at Computex a couple weeks back, or just 2 weeks ago, as everyone was saying, sure, we have 60,000 chip data centers right now. That could easily get to a 1 million chip data center. That continues to benefit NVIDIA. That's why we have analysts come on our show talking about how, yeah, this market cap that we've seen it get to, this $3 trillion, could just be the still starting point
Which
here.
is crazy.
Yeah.
And especially after the 10-for-1 stock split.
Right.
One question I had was, have we reached a ceiling? Where is there more room to run here? And consistently, we've heard from guests that on our show, analysts, they're saying that there is more room to run. Gaming, automotive, they're two areas of the business that there's some potential growth opportunities there.
Yeah, NVIDIA getting the best positioning stature from Oppenheimer on this, from the full stack AI hardware, networking, and software solutions here. So we'll continue to track shares of NVDA throughout the week here. But simpler ticker symbol. GM, General Motors, authorizing a new $6 billion share buyback program and raising its quarterly dividend by 33%. The automaker saying in a statement it's, quote, growing and improving the profitability of its EV business, allowing it to return cash to shareholders. Now, for anyone that can remember back to last year, there have been a few different accelerated share repurchases. November 2023, even the company noting this, in 2023, they had announced that $10 billion accelerated share repurchase, continuing to have approximately $1.4 billion in remaining capacity under that prior share repurchase authorization as well. And they had also been purchasing throughout Q1 of 2024 as well, about $300 million worth of shares purchases then, and expecting to exhaust the remaining $1.1 billion before the end of the second quarter.
And look, this share repurchasing narrative, the dividend story, it's one that we've seen from these big companies since the start of the year. And this is a fun stat. 42 other S&P 500 companies have announced buybacks this quarter, so continuing to return that value to shareholders. Bank of America also came out with a note saying that they expect continued pickup and that corporate client buybacks just last week were the second largest in its weekly tracking history since 2010, with 70% of year-to-date S&P 500 buybacks being in the tech and communication services sector. So this is something that we're consistently seeing, and for GM in particular, comes on the heels of the growth of that EV business, which we know came a little bumpy at the beginning for them, but they're committed to this market.
It's going to be a big update. July 23rd, 2024 is when they release their next quarter earnings results. We got a little bit of time till then, though.
Well, stay tuned for Wealth. Our very own Praz Supermanian will join us live from Deutsche Bank's Global Auto Industry Conference for a conversation with GM CFO Paul Jacobson. You won't want to miss it. We're just minutes away from the opening bell. We're taking a look at how the trading day is shaping up as the Fed meeting kicks off later today. That's right after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
All right, we're approaching the opening bell here, just seconds away. Can you feel the energy here coming off of some new records that we saw just yesterday, Allie?
Yeah, records for the S&P and the Nasdaq, especially since most of the day we were under pressure yesterday, but we got those new highs for those two indexes. We'll see if we can potentially reach new records today.
Absolutely. We're taking a look at the futures here. We are down across the board as of right now. We'll see what the opening cross holds for us, see if we can see some flip activity into the positive territory here. Of course, a large trading session ahead of us, especially with the beginning of that two-day Fed meeting. Our own Jennifer Schonberger, she's going to shoot us that email once they begin, and ultimately we'll see what tomorrow holds when that decision comes forward. It's going to be an interesting one, though. You got CPI out tomorrow morning.
CPI, the Fed dot plot, a lot of things happening, and there's the opening bell.
Yes, you got First Horizon. Man, the great folks there ringing the opening bell at the NYSE. Ticker symbol FHN. Fun, kinda. And Confluence, they're ringing the opening bell at NASDAQ. You're watching the Morning Brief, everyone, brought to you by Invesco. Let's do a check of the markets now that the funfetti is in the air and markets are moving everywhere. All right, Dow Jones Industrial Average right now begins the day to the downside by about 0.4%. You're also seeing a move lower for the S&P 500, that beginning the day down by about 0.25% here. So ultimately for the Dow, the Nasdaq now that's calibrated, that's down by about 0.2% as well. So fractional declines across the board. Allie, let's take a look at some sectors here very quickly. I think I had them pulled back. Hey, there we go. All right, not looking good.
Not looking good. And I'm curious how Apple is going to do throughout their trading day. We saw them close down about 2% yesterday on the heels of that big event unveiling Apple artificial intelligence. We were pretty much flat in the pre-market trading. We'll see. It might be under trenders too.
Yeah, let's take a look at the NASDAQ. There you got Apple right there.
There you go. So up about 1% at this point. So we'll see throughout the day if that changes as investors really start to digest the new features and announcements that we got.
Yeah, just getting back into positive territory over the past few weeks on the year-to-date scale, so we'll continue to watch that for shares of AAPL. We've also got Jared Blickery standing by.
Yeah, Jared Blickery, what is moving markets today?
Well, I'll tell you what, it's what's not moving. Let's answer that question. The markets have been kind of quiet lately. So here's the S&P 500. I'm going to show you a year-to-date on the Wi-Fi Interactive. Now, as you said, we are just coming off record highs here. So this is not a bearish warning, but I would note that volume has been drying up. I think 3 or 4 out of the last 5 of the lowest volume days in SPY, that's the S&P 500 ETF, the biggest in the world, have been the lowest of the years. So volume is low, complacency is high, and that's a setup you see sometimes when markets want to throw you a curveball. Here is the VIX. VIX is also pretty low. You can see we got just a 13 handle on it right now, 13.08. That is in the lower end of a historical range. But let's go through some of the sectors. Now, it was interesting. Here's the Nasdaq 100. You can see more red than green, but I was tracking tech early, just before the market opened. Tech was the worst performing sector. Now it's the least bad, but as you can see, everything is underwater here, and utilities taking it the most to the downside. That's down about 1 1/3%. Been interesting to track the movements in the bond market, but I do want to get over to our leaders here, because what you're going to notice at the very bottom, the only dark square there is GBTC. That is my crypto proxy. So let's take a look and see what is going on with crypto here. We've recently had some big days, but yesterday was a pretty big down day. In fact, it was the worst in about a month. And here's a year to date. And what this simply shows is Bitcoin has been consolidating near its highs, and until it breaks out either to the upside or the downside here, not really having much to talk about. Guys.
All right, Jared. Well, hopefully we have more to talk about later in the trading day. Thank you so much for that. And Treasury yields edging lower, with investors looking to 2 crucial tests for the markets this week. The Consumer Price Index for May will be released tomorrow morning, followed by the Federal Reserve's policy decision in the afternoon. So what's the best way to position your portfolio ahead of these 2 big events? Let's bring in Ed Perks, Franklin Templeton Income Advisors Chief Investment Officer. Ed, thank you so much for being here. I want to start on fixed income. You're overweight on fixed income, so bullish on bonds. Why do you view that as an attractive asset class at this point, especially ahead of that CPI print tomorrow and the Fed decision?
Yeah, hi, thanks. It's great to be with you. I think first, as we look at fixed income markets, it's just such a different landscape today than it's been, for really much of the last decade, if not even a little bit longer. So just the outright attractiveness of yields for anybody seeking income, certainly that's a game changer from what we've experienced. Now, I think as we look year to date more recently, as you just said, we're kind of around 4.45%. That is kind of towards the upper end of where we've been here year to date, really the last year. Briefly just ticked up a little bit higher than that. So that it actually has been a bit of a headwind for bonds, but we really see that dynamic changing as we get through into the back of the year and into 2025. The Fed cutting, even if just modestly, we see the headwind abating and possibly even turning into a tailwind for bonds.
And so, with regard to that, how aggressive of a cutting cycle are you anticipating as you look into and through the bond market?
Yeah, we still think there's a fair amount of just normalization in rates that can occur. So, the Fed, I think, is going to stay put tomorrow. It's going to be a pretty boring meeting, actually. I think it'll be interesting to see the economic projections that come out and how they change, if at all, from the March projections. But we really, as we get into 2025, we still have conviction the Fed's going to continue to see disinflation towards their target, and that'll allow that normalization more towards the neutral rate. And I know we can debate whether that's 3 or 3.5, but that's a long ways from where we sit today. So right now, not a lot priced in for 2024, but we think that accelerates as we get into the back end of the year and the expectations for the first half of 25.
Ed, you mentioned those economic projections. Part of that is the Federal Reserve's dot plot, which maps out where Fed officials think interest rates are going to be heading in the future. Do you expect more volatility in those dots? And there's also that overhanging question of, should markets put so much weight in the dots, considering that it is just a forecast?
Yeah, it's great to look at on a chart, but ultimately we try to throw out the highs and the lows and see a little bit more where the broader consensus is on the FOMC, and I think that's a bit more telling. We don't really expect a huge change. The data was, the economic data earlier this year into their last meeting was a bit hotter. We've seen a little bit more balance to arguably even a little bit softer broad economic data the past month and a half or so. I know we had a good non-farm payrolls, but there's been other stuff in the labor market that shows a little bit more balance as well.
Certainly. Ed, while we have you here, I mean, when we're thinking about where some broadening could take place in this market, where does it seem like there's a ripe opportunity for investors?
Yeah, I mean, we think it's very much a market of haves and have-nots. We know the haves have been the AI leaders. It's a very narrow market. I think we saw something earlier today about the top 10 weighting, more than 3/4 of the total return of the S&P 500. It's not quite the Magnificent Seven anymore, but it's maybe a little bit more the one and only if we're talking about NVIDIA and its contribution to the S&P returns. When we look at kind of the average company, there hasn't been a lot of performance. Valuations arguably have gotten a little bit more attractive for the average stock. Certainly of this past year, the probability of a recession has come significantly down. And I think that improves the outlook. So, we are looking at that kind of broader cohort of companies that are not at 52-week highs. They're significantly off. A lot of really quality companies that we've found for our income strategies. So these are dividend payers that have, as we look something more in that 16 to 18 times earnings expectation. So pretty reasonable.
So what companies or sectors that you're talking about would you be putting money to work right now?
Yeah, that's, I think, another really interesting part is that it's been kind of across sectors. So, a name like Air Products earlier this year, really kind of disappointed. And we're kind of seeing this overreaction to companies. Coca-Cola is another company that came down pretty meaningfully, even within technology. If we go back earlier this year, when Google first launched their AI initiatives, it kind of fell flat a bit. The stock came down. It's now kind of recovered. And I think there's a little bit more confidence that they'll right that ship. So all of these have kind of created opportunities within the market, pretty broad range of companies. One right now that I think looks interesting is Home Depot, where you're well off of the 52-week highs, and with this broader backdrop and the expectation that into year end, into next year, rates will be coming down. That could be supportive of the housing market, and that's a stock that we think investors should maybe take a look at here.
Ed Perks, Franklin Templeton Income Advisors Chief Investment Officer. Great to have you on the show. Thanks for kicking off this session with us.
Thank you.
Coming up, we go live to Deutsche Bank's Global Auto Industry Conference, where our very own Pras Subramanian will be joined by Ford Vice Chair John Lawler. You do not want to miss it. Welcome back to the Morning Brief, brought to you by Invesco. Ford reporting sales growth of over 11% in the month of May, driven by a nearly 65% boost in hybrid sales from a year ago. But with overall electric vehicle sales raising concerns about a possible slowdown, what does this mean for the auto giants moving forward? Yahoo Finance's Pras Subramanian is standing by live in living color at Deutsche Bank's Global Auto Industry Conference with Ford Vice Chair John Lawler for more. Hey, Pras.
Hey, thanks, Brad. Yeah, we are here at the Deutsche Bank Global Autos Conference, and John Lawler, new Ford Vice Chair here. Congratulations on the new role.
Thank you.
So I know you're going to be presenting soon here. Give us some updates on what you're going to be talking about here. What are some of the new projections potentially for Ford right now going into 2024?
Well, we had a good start to the year with Q1, and we'll be talking about where we're headed with the business. You know, Ford Plus strategy is really about focusing in our customers and their needs. And you start to see that really come through in the segmentation we did, in that Ford Pro customers are distinct from Ford Blue customers, which are distinct from our electric vehicle customers, and how we're progressing our strategies in each of those spaces, how we're providing them value, choice, and we're moving the business forward.
You know, you guys had May sales recently, very strong month, both not just traditional ICE vehicles, but also hybrid and EV. Let's talk about hybrids. Did you guys envision that? You know, a year ago, we were talking to you guys at the Delivering Ford Plus conference. EVs are the big push. But look at hybrid sales. How do you explain that?
Yeah, so when you think about hybrids with Ford, we've been in hybrids for over 20 years. We're number 3 in the US in hybrids right now. Now, our hybrid sales grew 40%. They're going to grow 40% this year. You can't just turn that on with a switch. So all the narrative and hype had been around EVs, but we never walked away from hybrids. We always had those in their cycle plan. They were always funded. And you're seeing that now as the demand's increased. We have the capacity to provide for consumers, and you're seeing that take place. So we're really pleased about our choice that we have for customers across gas, hybrid, as well as electric vehicles.
I think the Maverick in particular has been the sort of a focal point here with the compact sort of a pickup, but then also being provided with hybrid power, which I think was interesting when it came out. Pivoting to EVs now. So we're also seeing, we've seen the EV sort of demand story kind of slow down a bit, but EV sales, in particular for Ford, quite strong still. What's your kind of take on that, and how do you kind of bridge the gap to when those vehicles are profitable?
Right. So the way we think about EVs, it's not a matter of if, it's when and how fast. And so we did see a slowdown relative to what people expected. But I think there was a false signal coming out of COVID is how quick the demand was going to grow. And that was because the early adopters, they were really excited about having the choice of vehicles, electric vehicles. Then when you get to the early majority, they're not willing to put up with some of the other issues that you might have with an EV around range, et cetera, like those types of things. So choice is important. And it's coming through where you have hybrids, where you have plug-in hybrids. Other technologies are coming along as well that I think will help that transition. So I think you're going to see the growth continue. It's going to be a little bit slower than what we've seen in the past. Now, of course, for us, getting to profitability is key. With our segmentation, you can see exactly how we're performing in the EV space, and we have plans to improve that. Primarily with our second generation of vehicles, where we'll see step function changes in cost and performance of the vehicles. And that's where we think we'll really start to gain traction from a business standpoint for our electric vehicles.
So really, profitability may come in those second-gen software-defined type of EVs, right?
Exactly. So the second-gen vehicles, not only will the software capability of those be, so they'll be connected digital devices, but as well as the cost structure of those vehicles is going to improve dramatically through battery technologies, efficiency of design, et cetera. Because our first generation vehicles, to get to market quick, we converted gas vehicles into electric vehicles. These are ground up platforms designed specifically to be EVs.
So you mentioned, let's pivot back to sort of the guidance here. You're talking about how 2024 is shaping up, strong sales so far. You kind of still see that $10 to $12 billion adjusted EBITDA kind of guidance, that target there?
So when we came out of first quarter, we had guided that we would be at the high end of that range. And so, that's where our guidance sits right now. Yeah.
I want to talk about your new role as vice chair. I've known you as CFO, grinding those numbers, but now it's more about sort of the strategic part of the business and how you kind of leverage relationships. I know you used to work in Europe and Asia, and you're going to kind of go back to those roots, right? What's the new role going to entail, and how do you kind of make Ford more efficient from that point of view?
Right. So it's really around strategic initiatives. The level of change in this industry is unprecedented right now. You have the propulsion changes, moving from gas to electrification. And electrification is going to take many forms as we're starting to see develop. You also then have the digital technologies and the platform. So I'm going to be focusing on which technologies we're going to move into, alliances. And as you said, partnerships are going to be key, because one of the issues with this industry has been capital efficiency. And a way you work through more capital efficient structures is through partnerships and sharing some of that capital footprint. So we're going to focus on that. And then, of course, I've worked all over the world. I spent 6 years in China. I've worked in Europe. I've worked in Japan. And I think I can add a lot of value working with governments and their leaders on the policies and how Ford can help and how Ford's going to interface in those markets around the world.
Just real quick on China, is Ford still kind of focused on that? Is it more of a JV type situation?
Well, we've always had joint ventures in China. We have 2 joint ventures in China, one more commercial vehicles, one for passenger vehicles. They're really important partners for us. I love our strategy in China. It's capital light. We're profitable in China. We're exporting from China. We're growing from that market base. So we have a lot of possibilities in China, and I'm excited about the future there.
John, thank you so much. I appreciate your time. China, 2024, all that stuff going on right now. Back over to you guys, or back over to break. More Yahoo Finance Live after this.
As investors await more guidance from the Fed on Wednesday in their meeting, once that press conference happens, every piece of data will be evaluated for hints about the path of the Fed moving forward here. For our next guest, he's arguing that there are clues within the data that indicate buying opportunities this summer. For more, we welcome in Paul Ciana, who is the Bank of America Chief Technical Strategist. Great to have you here in studio with us.
Thank you. Great to be here.
Absolutely. So first and foremost, I mean, investors are just looking for signs right now. Are there kind of glaring signals right now that are telling us that there are buying opportunities that could be had this summer?
I think there definitely are. Look, from a technical lens, we're less worried about the headlines and the macro and the issues at hand because price tells the truth. And when we look at charts of like the 10-year yield, for example, and we practice some of our typical, trend following methods, we believe with a strong conviction that last year in October, 10-year yields peaked at 5%, and we've begun a cyclical bull market in U.S. Treasuries. We saw 10-year yields slide from 5% to about 3.78 ending last year, and they've risen back to about 4.75 this year. So we think that point of this year, just before Memorial Day, was actually the peak in 10-year yields likely for the year, and we're in a buy the dip markets for the next corrective leg lower in yields.
So where do you see the yield going to? Obviously, there's been some volatility. We saw a 14 basis point jump after that hot jobs report, down about 2 basis points now. Could we get 5% this year, or do you see that as sort of the top?
Yeah, short-term technical patterns are always developing, which could indicate move back up to 4.75, maybe approaching 5%. And what I love about that actually happening is then we would be able to form a big top in the 10-year yield chart, which we don't have yet. But I think if we just kind of look through the, forest for the trees kind of bias and technicals here is, if we're up around 460 or so in the 10-year, we should be nibbling long. If we're retesting the year-to-date high in 10-year yield of 4.74%, we should be buying. If we're above that, we should be loading the boat long, because the second half of this year and our technical methods look much different than the first.
I'll be honest with you. One of the questions that I get over the course of the weekend from time to time from a few friends who are good viewers of the show, they ask, all right, what is the strength of the dollar right now, especially in correlation to what we're seeing in the jobs economy even? How do you kind of run that correlation?
Yeah. So 2 things on that. One, interest rate differentials are certainly driving FX markets a little crazy, especially as more kind of macro geopolitical headlines get into the mix. Sure. So, that stuff kind of aside, which is a little bit harder to forecast, I think the jobs market in a way is a layup for technicals because it does represent a lot of the basic methods that technicians tend to use. And I think the unemployment rate is a great example of that. More recently, the U.S. unemployment rate reached a 2-year new high. Right? A 2-year new high in the U.S. unemployment rate. That's the worst labor market in 2 years. Now, the labor market is by all means not bad right now, right? It's a pretty strong labor market out there, but we're trending in the wrong direction. So here's a chart of the U.S. labor market double bottoming in the middle of last year, now at 4 higher highs and 3 higher lows. Right? That's the basic definition of a technical uptrend, which to me means the labor market is potentially on the cusp of weakening more than priced.
So do you think the markets are underpricing a potential hard landing moving forward?
Yes, I do. That doesn't mean I'm calling for a hard landing, but based on how markets are priced, they're essentially priced soft landing, maybe no landing, and hard landing is basically 0, right? So there's a saying in markets, hedge when you don't need to. Now might be a decent time to think about that.
All right, well, hopefully that doesn't come to fruition, Paul, but thank you so much, Paul Ciana, Bank of America Chief Technical Strategist. Appreciate your insights.
Pleasure to be here.
Yeah, of course. This morning brief brought to you by Invesco, and let's take a quick look at markets. You're seeing red across the screen right now. The Dow is down about 370 points, or almost 1%. S&P 500 down about 0.5 there, and then the Nasdaq, the tech-heavy Nasdaq, there also in the red today. Coming up, Apple's big AI announcements didn't move Wall Street too much, but could it spur a rise in sales for the next iPhone? We'll discuss. Plus, from copper to municipal bonds, we'll dive into some alternative investments you may want to keep your eyes on.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
It's 10 a.m. here in New York City. I'm Madison Mills alongside Alexandra Canal. We're going to dive into the catalyst moving markets today.
Apple joins in on the AI hype, announcing new features and a partnership with OpenAI that could bring generative AI directly to customers. Is this enough to boost lagging iPhone sales? We'll discuss.
And Tesla shareholders expected to vote on CEO Elon Musk's $56 billion pay package on Thursday. We'll discuss what this means for the company's future.
And outside of big tech, markets face another big test on Wednesday with CPI and the Fed decision in focus. We'll track how the data moves markets. But first, we have to talk about today's big story, Apple's AI announcements. The new features called Apple Intelligence will only be available on a limited number of devices, including the iPhone 15 and upcoming 16. This comes as iPhone sales have been under pressure in recent quarters. Is this enough to offer a boost? We spoke to Gil Lauria, D.A. Davidson Managing Director, about how AI changes Apple's position among its competitors. Here's what he had to say.
We think it took the lead. Because again, everybody else has to try to fit their solutions elsewhere, or it really doesn't have access to the consumer and the consumer's information. Apple has our information.
All right, Maddie, so this speaks to the tagline that Apple used, right? AI for the rest of us, a bit of an homage to the 1980s when they had the MacBook out, the computer for the rest of us, and really the personalization of Apple and how they have access to the customer data. And they really want to double down on making sure that all these AI features are for the benefit of the consumer. So that means if you have a meeting coming up, Apple can say, hey, you're going to be late to this if you don't do X, Y, Z. So a little creepy. But, you know, they also said that they want to protect people's privacy as much as possible, that it's not going to train OpenAI models. So we'll see once that goes into practice and this is adopted more, if that becomes an issue.
Well, it's such a great point, and this is the key sort of catalyst for Apple moving forward. Are they going to be able to continue to keep consumer privacy in mind, which has been a key, really success point for them in the past, the ability to prioritize consumer privacy. They do say that every time you're going to be utilizing a ChatGPT powered function on the iPhone, you're going to get prompted with a request of whether or not that's okay, but that will inevitably send your data over to OpenAI. So I think a big question moving forward will be consumer comfortability with OpenAI versus Apple. Those are two different functions there, and the degree to which consumers even know about that will also be another question. It does look like Apple is moving to the upside here, so interesting to see investors maybe being a little bit more positive today, coming back off of those lows yesterday, Allie.
Yeah.
And continuing this conversation around Apple, we initially saw a muted response from investors after those announcements we were talking about. Shares moving to the upside over 3% here today. We have one of those investors here with us. We've got Apple shareholder and CEO of Mahoney Asset Management, Ken Mahoney. Ken, it's great to speak with you. I know that you did not change your positioning after the news over the past 24 hours here from Apple, but you know a really interesting point about the impact of the announcements that we've been hearing from Apple here. I'm curious, what was missing from the announcement that would have made you a little bit more enthusiastic? Because in reading your note, I feel like I can summarize it as just a big shrug to the news.
Well, I think long term it's great. You have this huge buyback in place, $110 billion buyback. There's a couple shekels here. You have a huge upgrade cycle that's going to come out of this. I mean, there's 270 million phones out there that are 5 years or older. That's a big opportunity. But as far as the technology, again, I just rely on a lot of old technology research. You know, they thought it was a yawn. They spent a lot of time on Surrey, which I like Surrey. Hope Siri does a little bit more, like Siri on steroids with this new AI model and so forth. But I don't really see it as a yawn, as more just like, this is Apple. You know, they have 2.2 billion devices out there. Last year, they had 2 billion devices. Tim Cook did a great job kind of pivoting our focus from hardware sales to really services. And this is really where this is going to blossom. So it's not so much a yawn as it is, this is what's expected. You have this many customers, you know, tweak here, tweak there, join the party. And I think they'll succeed. Does it have explosive upside like NVIDIA? No. Does it have explosive upside by other areas in AI? Not necessarily. But there's a pretty good Apple put when you have $110 billion of share buyback underneath you.
So what more do you want to see when it comes to Apple? Where do you think that upside lies? And we should mention that the stock is now hitting an intraday high as investors are starting to digest some of those new features. So it seems like even though it might have been a bit of a, I don't know what this means moving forward yesterday, today we're seeing that share reaction in the positive. So for you, what do you want more of here?
So what I would like to see more of is better integration from the Mac to the iPad to the iPhone. You're starting to see that, but to really work that, and really Siri being the head, you know, kind of the head person there, putting all those things together, as you mentioned, scheduling appointments, reminder appointments. There's one app on there that was kind of cool. Like if you're supposed to pick someone up at an airplane, at the airport, it tells you kind of, oh, the airport, you should be leaving soon. You should be leaving in 10 minutes if you want to meet that person. So there's going to be a lot of applications. I guess it's just kind of overwhelming the amount of applications, AI that could go about. Again, the biggest thing is they have all these customers and they want Apple to take the lead. And I'm not sure necessarily Apple's taking a total leap of faith into this. I think they're kind of, okay, we'll do it, but we'll put it on top of AI, we'll put it on top of Siri, as opposed to kind of blazing a new trail.
Well, one question I have is who's going to foot the bill for everything that you just described, Ken? Apple's saying they're not going to pass off the costs for ChatGPT to customers. Does that mean Apple takes on those costs? And to what extent is that a headwind for their profit margins?
Right, but this is a monetization area that they haven't had before. So, you know, even it's a small piece of the pie because it's percentage breakouts with developers and so forth. I mean, it gets kind of complex how they're going to do it. But in the end, they're in the driver's seat, and that these companies have to come to Apple if they want to play. So I think this is still going to be a pay-to-play model, much like it is on the App Store as we see it.
So you're saying that the ability to charge customers for utilizing specific AI features is going to outpace the cost of those features for Apple?
I believe so. I believe so. Look, they have a lot of different avenues they could take this with. But I think that's probably the best way to monetize a site, to be able to have happy customers and to entice others to this upgrade cycle. Look, we're in this mix here. I've been telling investors we could hit a low with Apple over the summertime. As why would you want to upgrade your phone here? Why not wait for the 15 or the 16 and so forth? So we could hit a little low. But then again, once you see like a cool feature and you see it on Instagram or your friends using it, you know, they're the early adapters usually to this type of technology. And then behind are people like me say, oh, you can do this, you can do that. And so that is where Apple is going to be able to monetize the site more, is new features and new ways and new apps all around AI.
And Ken, we spoke with Gil Lauria from D.A. Davidson earlier this morning. He said that when it comes to the competitive landscape in AI, that Apple is in the lead. Do you agree with that?
I'm not so sure. I would say NVIDIA's in the lead. I mean, this is pretty much drawn up by the CEO of NVIDIA, who said, by the way, we're in the second or third inning of this cycle. I'm not sure Apple is in lead, but they don't have to be in the lead. You know, they're the big, they have 2.2 billion devices out there. So it's, you know, developers and all of them could come to Apple. But I don't think necessarily they're taking a lead. I would say NVIDIA kind of end around at, you know, $3 trillion market cap, and, you know, just added on $1 trillion in the last 6 weeks kind of shows that NVIDIA is probably the leader in the space, not Apple. But still, Apple doesn't have to necessarily be the leader in the space because they have all these customers, obviously, and the ecosystem, as you know. Once you're in an iPhone, typically you're going to stay there. You don't want to lose your photos, don't want to lose your contacts. It integrates with your Mac, integrates with your iPad. So they create this great ecosystem, and they can just add services on top of that with the base that they have. I think it's still a win-win for shareholders.
I want to talk about one other risk for Apple, and that is Elon Musk. He posted on X yesterday saying that if Apple integrates OpenAI at the OS level, then Apple devices would be banned at his company. He's calling it an unacceptable security violation. How big of a risk is that for you and your asset holdings here?
Right, so it's just still trying to figure that out. And again, we have to take Elon Musk's word. I mean, he's a very smart individual, and he's always kind of looking ahead where things are. But again, I would think there's an opt-in. you opt into this AI platform or AI ChatGPT, whatever, and it tells you here's disclaimers. So it's really up to the consumer to decide if they want to go in. So I don't think Apple's just going to just take your data and feed it over there. I think they're going to have a few speed bumps that I think consumers will be happy with. Remember, Apple's always been high in integrity about collecting data. They have all this data. They're not selling to third-party vendors and all stuff like that Facebook did some years ago. So again, it's always good to hear different opinions. We heard from Musk in the last 24 hours, but I do think Apple will find ways to safeguard their users.
Okay, well, we will see what happens there. Ken Mahoney, Mahoney Asset Management CEO, thank you so much for joining us.
Great, thank you.
Stocks moving lower this morning as investors await two big tests for the markets tomorrow, CPI and the Fed decision. Even with fears around higher for longer rates, strategists broadly expect big tech to lead stocks higher through year end, driven by AI demand. Our next guest is one of those strategists. We have Abby Yoder, JPMorgan Private Bank US Equities. Abby, thank you so much for joining us in studio. And you have a pretty bullish outlook here. 5,500 year end price target for the S&P. You see that going up to 5,750 next year. What's driving that?
So I think importantly, when we're thinking about the breakdown of returns, right, that's earnings and multiple. When we're thinking about both the 5,500 and that 5,700, that's all coming from earnings growth. And that's between 8 to 10%, depending on what calendar year you're looking at. And the majority of that is being driven by tech, right? And what we saw in Q1 was this really, just strong across the board quarter in terms of earnings. We saw all 11 sectors beat in Q1, but a lot of that strength was driven by tech. And in particular, we saw their margins expand. And so that's very important to us when we're thinking about, 60% of costs are fixed. How do you see that incremental uptick in terms of earnings growth? We're seeing that from tech in terms of their margin profile. And then on the valuation front, we actually have valuations contracting a little bit. And that again is also being driven by tech. And when you think about it from a natural standpoint, their prices are high and their valuations higher than the market at the moment, but they're going to grow into that valuation, right, through their earnings growth, so then you naturally see that valuation compress from a large cap tech perspective.
And that seems like a critical part of why you're able to make the tech sort of rally, but also inherent concentration within tech part of your bull case when we have a lot of other guests come on and say that the concentration of the rally in tech is a bearish signal for them. How are you thinking about the differentiation there?
Well, so there are two things that I would point out. One, the concentration is being supported by the earnings, right? So you're seeing not only the concentration from a market cap perspective, but you're seeing it from an earnings because they continue to outgrow the rest of the market. Now, coming into the year, we really were thinking that there was going to be this broadening out in terms of the equity market performance into the year end, and we still do believe that. But what you're seeing is that was predicated on the growth rate differentials getting narrower, right? And so what we've seen is we're still seeing that narrow as the rest of the, let's call it 493, 494, catch up to the rest of the Mag 7. But what you're seeing is the tech growth rate is staying elevated, right? So that saw a little bit of an uptick in 1Q. So it's still driving the market in mid-teens EPS growth through the end of the year, but you are starting to see, as other sectors come out of their rolling earnings recession, you're seeing their earnings growth also pick up. So a little bit of a broadening out, just not to the same magnitude.
When do you expect, if at all, we're going to see that same magnitude of broadening out, and what sectors do you think could benefit from that?
So that would be like a second half phenomenon. And I think for us, when we're thinking about it, so we're overweight 4 sectors. We're overweight technology, consumer discretionary, healthcare, and industrials. And I would say at the forefront of really coming out of that earnings recession is healthcare. Healthcare saw their first negative annual earnings growth period last year in 2023. There was a lot of COVID digestion going on across different parts of that sector. And they're about to flip from negative, so they had a negative 1Q or year-over-year earnings growth rate, and that's going to flip positive as we go through the back half of the year. So you pair that with really attractive valuations in the sector, and that to us is a pretty nice setup in terms of healthcare.
I was talking to a source about the healthcare sector yesterday too, who mentioned that their ability to kind of navigate the higher for longer environment is a differentiating factor as well, and the ability to not have as capital intensive sort of expenditures on the balance sheet. How much of that is a line of thinking and an investment thesis that our investors listening to this should be really looking at in this higher for longer environment? Does that apply to other sectors as well?
Yeah, I mean, for healthcare, yeah, they're not as dependent on the interest rate environment when you're thinking about large caps, right? Like, let's be very clear. Small cap biotech is a totally different story. It's riskier. It's much more, I would say, exposed to higher interest rates and will be challenged in that environment. But yes, from an overall large cap healthcare perspective, I mean, it's defensive. It typically, again, usually has positive earnings growth, and we didn't see that last year. So I think that's a nice differential as well. Industrials is something that we would think would actually benefit from a higher for longer rate environment, right? When you think about the cyclicality of that, we're seeing PMIs, what we think is bottoming, and then you've got structural tailwinds around things like AI. So that's another sector that we do like, interest rate agnostic as relates to industrials.
And speaking of higher for longer, we'll have updated economic projections from the Fed tomorrow. If we see less cuts projected by the Fed, is that a risk to the market? What if the Fed doesn't cut at all?
Yeah, I mean, look, I think the risk as it relates to the Fed is not necessarily whether or not they cut at all. Right now, we actually only have one cut penciled in at the end of the year. It's really like, what is the next move and what signal does that send to the market? And I think if the next move were all of a sudden to become a hike, then that is a totally different story when it comes to equities. But as of right now, we are still of the base case that we are going to see inflation gradually come down, which is going to lead to that cut. It just seems like it's going to be later than what was originally anticipated in the beginning of the year. And I think the question is really getting at, okay, what does that mean in terms of valuations? How can we continue to defend these valuations? And I think it's a really, and I think this is where the equity risk premium conversation comes in as it relates to equities. So how do equities look relative to bonds? And if you look in the past 15 years, they look really expensive on an equity risk premium standpoint. But if you extend that out to a period before the global financial crisis and interest rates were at zero, the equity risk premium was more compressed, similar to how it is today. And so if you're thinking about the risk of inflation remains elevated, but the risk of recession feels relatively low, I think in that tug of war of arguments, I think equities win in terms of relative to fixed income.
Zooming ahead to Friday, Abby, when we're all heading to our Friday evening happy hour to talk about financial markets, as we do, what will you say was the single biggest driver of the week? Will it be the macro news, CPI, the Fed, or a lot of the tech headlines that we're getting from Apple, from Tesla, and as always, NVIDIA as well?
I think we're in a little bit more of a macro vacuum, let's call it, till we start earnings season again back in mid-July, right? Like, I think a lot of the rally that we saw when the market bottomed on April 19th through, end of May and now was really earnings driven. I think it was fundamentally driven. I think, yes, there were definitely some tailwinds as it relates to from a macro standpoint, from a softer inflation print that the market really needed. But I think right now it's going to be more macro driven than micro at the moment.
Mm-hmm. Abby Yoder, JPMorgan, private bank U.S. equity strategist. Thank you so much for joining us today. Coming up, a new partnership with Apple is giving shares of Affirm a boost. We've got some top trending tickers on Yahoo Finance next.
get to some trending tickers that we are watching. Another day, another more expensive Spotify subscription. The company reportedly introducing a new higher-priced premium plan for its users that will charge customers at least $5 more per month for access to tools like better audio and additional tools for creating playlists. This is all according to Bloomberg News reporting. Of course, this is right after the company already announced new price hikes recently here, Allie. I know that you cover this name consistently, but I did want to give a shout out to our producer, Cheyenne Reed, who pointed out a critical question here. Are we getting low quality audio from Spotify now? And what tools are we missing out on? And I know it sounds kind of silly, but it is an important thing that I think comes with these price hikes from all of these streaming platforms. It's like, well, what is the differentiating factor between what we're getting now and what you're going to offer us? And is it good enough to warrant the price hike?
Right. And I think that's an interesting point, too, because Spotify has said in the past that they want to introduce different types of tiers. So perhaps a music-only tier, an audiobooks-only tier. So really allowing more optionality, more flexibility when it comes to the consumer. It sounds like from this Bloomberg report that this is targeting users of Spotify that are consistent, that really want the premium offerings, that hi-fi audio, the ability to curate playlists, and it's a specific type of customer. Not every customer is going to want to pay up for that, and I think that's important for all of these companies to start to understand. And Spotify is one that recently has had a pretty strong turnaround story. I mean, it wasn't too long ago that this stock was really in a difficult place, and we've now seen it build back up. Price hikes, obviously a huge bullish sign from analysts. Wall Street actually thinks that these price hikes from last week, that they're going to spread out to some other music streamers out there. So perhaps your Amazons, your Apples of the world are going to raise prices as well. And if you think about what it costs today, it's pretty cheap, all things considered. Yeah. You have access to all this music, access to all the songs. There's always that big question of the ripple effect there. Is it going to go towards artists? Is it going to go towards the labels? So this is a company that has multiple layers to it. And I think at the end of the day, they want to offer as much choice to consumers because there are some out there that are willing to pay up.
Yeah, and to your point, last thing on this, it's just an interesting story of them being defensive and offensive. This is an offensive move to protect their balance sheet, but they've also been having consistent layoffs over the past couple of years, and I know that was a previous story for them, but it seems like they're really kind of putting an iron wall around their balance sheet right now, which is something investors love to hear.
Right, they spent $1 billion in podcasts, so something's got to give.
Exactly.
At some point there. Yep. But more bullish signs here. Now, Shopify is getting a bullish call from JPMorgan, the firm initiating coverage with an overweight rating, saying the company's, quote, competitive moat warrants a premium valuation. You're seeing Shopify shares up a little over 1% there. Now, JPM added the company has distinct competitive advantages that will continue to fuel industry-leading growth. The bank also sees margin expansion opportunities as well. Now, if you take a look at a longer-term chart, shares have been under pressure so far this year, down about 17% over the past 3 months as well. But JPM saying that creates an attractive entry point for investors. So potentially more upside on the horizon. The bank has a $74 price target, so about 20% upside here based on current trading levels.
Yeah, it's interesting because this is another name that's been under a lot of pressure recently. Even just last week, we saw MoffettNathanson cutting Spotify to neutral. So the kind of opposite move as what we're seeing today in terms of the market reaction there. That price target cut coming from MoffettNathanson saying that they had previously, had an outperform rating on this name. The stock had risen an average of 63% in the period's rated market perform for MoffettNathanson, but now seeing the stock falling to the downside, and it points to kind of a broader question about what the long-term value add is going to be for Shopify and whether or not the kind of juice has already gotten as much squeeze as possible for some of these e-commerce names, particularly as we do start to see a little bit of struggle within the consumer space. What is that going to mean for a company like Shopify? Well, moving on, Affirm shares are getting a boost today after Apple announcing Affirm products will be available to U.S. Apple Pay users later this year. Affirm saying it doesn't expect the partnership to have a material impact on its revenue in 2025, but it's certainly having a material impact on the stock. That stock up nearly 6%. It was up over 7% earlier, and this is a big deal for Affirm. I mean, this is a company that has been seeking some of these partnerships pretty consistently, and to get buy-in from a name like Apple, you can't ask for anything more when you are a company like Affirm. You can see that the stock has really been on this sort of ripple effect. I want to take a look at what Affirm has been doing year to date. So I'm just going to pull that up here really quickly.
Well, it was the largest intraday jump since January that we saw today on the heels of that news. And, having these products available to Apple Pay users coming out later this year, it's something that you think would be a catalyst for the stock moving forward, especially as you think of the growth of buy now, pay later. I think back to Black Friday and Cyber Monday, there was a lot of activity around the buy now, pay later space. And especially as we're in this environment where, as you mentioned, consumers are a little bit squeezed, we're in this higher for longer interest rate environment, these are companies that could certainly benefit.
Absolutely. And just to get that stat in, this is a name that is down 35% year to date. I am very curious to see how long it takes them to get to the flat line on year to date after this Apple news, because again, that is the type of news that is exactly what a company like this is going to be looking for and what the street is going to be looking for as well. Really quickly, want to point out another comment from Affirm saying that this will enable users checking out online in-app with Apple Pay on the iPhone and iPad to pay over time with Affirm. So that could be another leading economic indicator for us as well, seeing how many users are using the pay over time option. Well, coming up, prices on copper. They're moving higher this year. We have seen a recent pullback though. So when is the time to buy into the commodity? We're going to discuss after the break. Copper having a record run this year, up over 15% year to date due to AI-driven demand, as well as increased interest in renewable energy. That rally is stalling over the past couple of months. So for more on these moves and what they mean overall for the commodity, we are joined by Adam Turnquist, LPL's Financial Chief Technical Strategist. Thanks so much for joining us. Really great to speak with you. I do want to start just by taking a big step back on copper, right? We know that we are in this higher for longer environment, so we are obsessively looking at every single data point to suss out where we are at in the economy overall. What can copper prices tell us about the macro picture that the day-to-day economic data might be missing?
Hey, good morning, and thanks for having me on. I think when you look back in the longer-term trend of copper, we're getting this large breakout from a bottom formation that's been forming. And if you think about copper as a leading economic indicator, just its vast application use, I think it's a pretty good sign overall for global growth, despite some of that noise that you mentioned in the economic data. Of course, what's happening in China is a big contributing factor to copper prices and overall demand as they try to revive their economy. There's signs of life emerging in the recovery there, although a bit slower than I think most expected. But I think when you look at the overall supply-demand backdrop, it does look constructive on a longer-term basis, despite this latest pullback that we're seeing off overbought levels.
So when do you think we're going to see a rebound in that price action? And what's the ceiling here for you when it comes to copper prices?
I think we're close to a potential spot where we'd have an inflection point. The 50-day moving average has been tested. Bulls seem to be stepping up and defending that level. We're trading right near those levels. Potentially, we could see a drawdown maybe to the 2023 highs, right around 425, 430. I think that would be a pretty good entry point if you're looking to get long copper, especially to play this energy transition. You think about demand outpacing supply longer term. It takes a long time to get copper out of the ground. And when you forecast some of the whether it's EVs or just the net zero emissions, there's not enough copper to meet the demand in the current state. So I think longer term copper moves higher and could easily go back and retest these recent highs in pretty short order. Speculators have been piling into this. This looks more like profit taking off overbought levels than anything else right now.
Well, Adam, another key driver of demand is, of course, artificial intelligence and the impact that has in terms of needs for data centers. The electricity grid is also key here. We have a lot of guests come on and talk about the importance of finding the pick and shovel investment opportunities when it comes to AI. Is copper as pick and shovel as you can possibly get if you're trying to play the AI trade?
I think it's a pretty good one. I don't know if it's as close as you can get with some of the other pick and shovel moves at the company level, but I think it's a pretty good play in terms of that energy transition that goes beyond just AI. And of course, AI is a huge tailwind for copper when you think about the electrification and the power grid. All of those are coming under massive changes over the next several years. Industrials would be another spot as an AI play. If you think about data centers, the manufacturing, the maintenance, that's another sector that we like as well, more at the equity level.
So you mentioned EVs, that overall energy transition. What are some other catalysts behind what's fueling the demand here for copper? Because I don't think investors realize that copper is behind a lot of different things that we use every day in our lives.
Yeah, outside of electric vehicles, which of course take way more copper, if you just look at the construction industry, that's the biggest in terms of demand for copper. That's doing quite well as we're building out infrastructure. Of course, that's been a big key move here that we like as well when you think about just the reshoring theme. And utilities are another one that obviously would be another spot for a AI play in terms of the energy transition here.
Adam, I'm not going to ask you to talk about a specific company, but hypothetically, let's say you've got the world's biggest phone maker saying that they are going to utilize AI. How much does a CFO of that company need to be worrying about the price of copper and the impact that could have as a potential headwind on their balance sheet?
I don't think it's going to be a major headwind when you think about the consumer, the elasticity of demand with smartphones right now, of course. The price points have not been a major factor. You can see that over the years as they've continued to increase. When you're talking about $2,000 phones with demand, it hasn't been a big factor. But at the margin level, of course, as input prices go up, that could be a factor that could impact overall earnings.
And I want to go back to China because you did point out that the supply side there is a bit mixed. Why is that not a concern for you in the long run?
Well, we're watching the supply side there overall, because right now, seasonally, it's at record levels. Typically, you see copper supplies in China elevate into really the first quarter of a part of the year, and then they start to dwindle as factory activity increases. We're not seeing that quite yet. But when you look at the futures curve of copper, and this is why we're a little bit, we're discounting that a little bit, is because we're in backwardation, meaning front month or spot prices are trading above second or third month contracts. That suggests there's a tight copper market on a near-term basis and supporting that, I think, bid into copper that we're seeing.
Yeah, Adam, and closing out the China's impact in terms of commodities, we are seeing muted demand coming from Chinese fabricators as well. So along with some of that profit taking, that could be a little bit of a temporary headwind for this commodity. Adam, thanks so much for joining us. That was Adam Turnquist. He is LPL Financial's Chief Technical Strategist on all things copper. Now, looking ahead to the 2024 election, we've got a new note out of JPMorgan saying market consensus is for Trump to win the White House. But overall, investors are not that concerned about the election, at least right now. Only 12% of JPM survey respondents see the upcoming election as the biggest threat to the market rally. Let's bring in Rick Newman for more. Rick, I immediately sat up when I saw this news because we've all been talking about what the market is pricing in ahead of this election. How big of a deal does this seem to you?
I think this market consensus is premature. This race is basically a toss-up, and it's very possible that whatever is going to turn the outcome either to Trump or Biden, assume both of them make it to the finish line, it's possible that that thing hasn't even happened yet. I mean, I think we've got more black swan risk than you normally would have in an election, given, number one, the age of these two candidates and everything that's going on with Donald Trump. We're going to have two debates. The debates can be decisive. Things can happen during those debates. And let's not forget, Trump is now a convicted felon, and there's going to be a sentencing in July when he may actually get sentenced to jail time. So I think it would be a big mistake to assume that Trump has this in the bag. We still have almost 5 months to go until Election Day, and there's just a ton that can happen between now and then.
Rick, you mentioned that first debate coming up at the end of this month. What do you think is going to drive the conversation points in that debate? Is it the economy? Is it geopolitical risks? Or is it something else?
Well, I have to believe the moderators are going to raise the issue of Donald Trump's conviction in the New York court a couple of weeks ago on 34 felony counts. I don't know that Biden himself has to say too much about that, but I think I'd be astonished if that is not, a huge focus of ads and billboards and swing state commercials, during the last 2 or 3 months of the election. I guess the moderators will ask about issues. I mean, there are a lot of issues at stake here, especially for investors. I mean, the big one is these tax cuts, the 2017 tax cuts that expire at the end of 2025. So the next president is going to have a major role in that. There's talk of either raising the corporate tax rate if you're Joe Biden, if President Biden gets a second term, or lowering the corporate tax rate if Donald Trump wins a second term. There are the tariffs on China that Trump wants to impose, and a lot of other factors for investors. I think it's just still too early for investors to be basically betting on the outcome of the election. But I think that's going to change in September and October. I think we're going to get a lot more intense focus on the polls in the 6 or 7 swing states. You might start to see the market go up or down based on what some poll shows, because there are a lot of issues that the next president is going to have to determine that will affect markets.
All right, Rick, a lot to keep track of. I know you'll be watching it for all of us. Thank you so much.
You betcha. Bye, guys.
Coming up, the NBA Finals are in full swing, and so are their media rights contract negotiations. We'll hear what NBA Deputy Commissioner Mark Tatum has to say next. Sticky inflation and a strong job market has sent jitters through markets over the past few months as investors brace for the possibility that rates could be higher for longer. But one investment vehicle has been seeing some benefits from the high rate environment, municipal bonds. Joining us now is Dan Close, Nuveen's head of municipals. Dan, thank you so much for joining us. Now, there is this expectation that the Fed could begin to cut rates later on this year. Right. Given that, is now the appropriate time to put some money to work in munis?
Sure, and thank you so much for having me, Ali. I do appreciate it. We certainly think so. I mean, if you look at what's happened to munis so far this year, there's been two broad themes. One is Treasury rates on 10-year Treasuries has gone up 50 basis points. So that's affected everything in fixed income, including munis, and 50 basis points cheaper than we started the year. And the second thing that's really impacted munis and why we think it's such great value right now is the supply of munis. We've seen supply go up of municipals through the end of May, up 40%. And with that, we've had two back-to-back months, the months of April and May, where we saw more than 40 billion of supply. I think what that really does is it sets us up really well for the second half of the year. The second half of the year, I don't think we're going to see as much issuance. We're hearing from underwriters, we're hearing from issuers, bankers, that they're bringing deals forward that normally would happen in the fourth quarter so that they avoid the election and they avoid all the issues that happened in the 2016 election. So I think we'll have less issuance, and I think we're also going to have a very, very good technical the next 2 months, where you're going to have $80 billion in coupons, in maturing bonds, in all these different proceeds that recycle back to the muni market very quickly. And those are both very, very good technical backstops. And I think as well, as we were discussing right before, 6.25% for a AA intermediate muni strategy, I think is very attractive. And 9.25% for a high yield, I think is just a number which is going to go in and draw investors off the sideline.
Yeah, I mean, those are significant yields, particularly when we're used to talking about things like treasuries, right, corporate bonds. The returns are just not as high. I am curious in terms of risks for those returns. How closely are you and municipal bond holders supposed to be watching the macro data and any potential softness we might be seeing in that data, and what read-through could that have to munis?
Yeah, sure. And we have 23 credit analysts at Nuveen where all they're doing is looking at the broader macro. And I think as I take a step back and look at it, we don't usually see a high correlation between the economy and defaults in municipals. Mm-hmm. By that I mean, your water and sewer bill. You're not going to go in and fail to pay your water and sewer bill no matter the economy. It's a really inelastic demand curve for most of what these have. These are essential service monopolies.
Somewhat recession-proof, is that fair?
Somewhat recession-proof. And almost everything we see, we just don't see a large correlation between defaults in munis and where the economy is, yes.
And given that, the muni space very fragmented, what sectors or areas are you most bullish on right now?
Yeah, so more than 50,000 different issuers. In the town I live in, I'm just north of Chicago, there's 9 issuers alone in that town. So it is a very fragmented market. On the high grade side, we're really looking at local general obligation bonds. These are bonds that are repaid by property taxes. We think with the housing market continuing to do well, that's a very good place to be, and they're offering very good yields. On the high yield side, we're really favoring land secured deals. These are deals that are financed by build outs in states like Florida for potable water, for streetscapes, and that are ultimately repaid by property taxes and different assessments. So we're very bullish on those two. We think those are going to do very well, recession or no, here over the next couple of years.
I do want to bring this a little bit closer to home here in New York City, because Governor Kathy Hochul did move to kill congestion pricing policy, and now some are calling on MTA muni bond holders to fight back against that move. I want to pull up a post from the director of a nonprofit focusing on public enterprise saying that I'm calling on anyone who purchased MTA muni bonds to come forward and bring the law to bear on the state of New York. I'm not going to ask you about congestion pricing. We're not going to get into that tit for tat here, but I am just curious generally, how much power historically do muni bond holders have over public policy? And is this a way for investors, retail investors listening to this segment now, who are invested in local politics, to maybe have another avenue of influence is not the word I'm looking for, but influence.
Yeah. Well, and it's interesting to see that congestion pricing would have been, we think, very favorable for muni bonds. You go in and you take $1 billion in what we expected the revenue to be. You could leverage it up to $15 billion by issuing debt that really helps out the capital structure. You know, if you go in and you have fewer cars on the street because of the congestion pricing, then you also go in and support the Fairfax bonds. You know, owning muni bonds, you don't have, unlike on the equity side, where you could go in and you could vote for directors and you could vote for different governance issues. We really don't have that as much. As large holders in the MTA, we certainly do have influence, but it's something traditionally asset managers, at least on the municipal bond side, have really exercised to too much. We have a 125-year history at Nuveen of providing tax-exempt income. Part of that is also knowing that sometimes the local matters and local affairs not weighing in on as much.
Well, really quickly here, I know that you had a take for us on airports and muni bonds, and obviously huge travel demand coming up this summer. What read-through does that have to airport bonds?
So airport bonds have done very well this year. We've seen about $3.5 billion of issuance. So Midway, SFO had an issuance. We've seen issuance come through and anticipate about $20 billion or so of issuance for the balance of the year. So I think it's been interesting. Airport credit has done really well. You think of airports that lost 80% of their top line revenue, and yet we have more upgrades than downgrades, and 25% of them are better rated than where they were before the pandemic. So in airports, we expect more issuance, and a lot of this issuance is not being driven by runways, it's not being driven by gates, it's being driven by the passenger experience, lounges and restaurants and shopping. And so it's more of an experience rather than that we're financing rather than the traditional brick and mortar. So we do anticipate more airport issuance for the balance of the year, fully $20 billion for 2024 and $150 billion by the end of 27.
Really interesting, Dan. It's always great to speak with you because you have an ability to bring muni bonds into the reality for folks. So really appreciate it. Thank you for coming in studio.
Thank you so much for having me.
That is Dan Close. He is Nuveen's head of municipals. Now, the NBA Finals are in full swing with Game 3 between the Celtics and Mavericks kicking off tomorrow night in Dallas. But while the games are still taking place on the court, a little game for the NBA executives deep in negotiations for their next media rights deal. Allie, I know you had the opportunity to sit down with NBA Deputy Commissioner Mark Tatum yesterday. What is sticking out to you from his comments about just the kind of back and forth of this deal?
Yeah, so he declined to comment on the specifics of the actual negotiations, but he did talk about how fragmented the sports media rights landscape is right now, and how, as any type of league wants in this day and age, not just the NBA, but also the NFL, NHL, MLB, you want to be as diversified as possible with your media partners. So we have a quick soundbite that I want to play where he talks about that a little bit more.
So over the last 5 to 10 years, sports consumption has been defined by an increase in optionality for the fan and ultra personalization. And so there are more ways than ever to watch sports programming, NBA content. And what we're trying to do is make sure that no matter where the fan is, that we're meeting them where they are, that we're customizing what they're seeing, the teams they're seeing, the players they're interested in based on their preferences. And so there's still very much a role for traditional television. We very much like the fact that our finals are on traditional network television, but we also understand that a new generation of fans are consuming content through streaming platforms. And so we want to make sure that we have that availability of programming and content across all different channels. So I think what you're going to see is more of a hybrid, having our games both on traditional television and streaming in an effort to reach all of our fans.
So a hybrid approach there. And if you think about the latest reporting around these media rights negotiations, that's exactly what's going to happen right now. NBC Universal, ESPN, they're in the league for linear. But also we have ESPN Plus, so that over-the-top streaming package. Amazon also in talks for an streaming exclusive package as well. And these are big amounts of money that a lot of these networks are willing to cough up. I mean, Amazon's $1.8 billion. NBC Universal reported $2.5 billion. Noticeably missing here is Warner Brothers Discovery's TNT, which has had the rights to this league for so long, but they're just not coughin up the cash that these leagues want.
And it seems like TNT sort of missed the boat by sloughing off the importance of this deal early on, is my interpretation at least.
Yeah, and also Warner Bros. Discovery is going through a transition period. Their balance sheet is all over the place. And some analysts have said, look, it might not make sense for them to pay this much for the NBA, while there are others that are like, no, this is very important that they have the NBA moving forward. So we'll see ultimately what happens. These negotiations are still ongoing.
And long term, whether or not this is an overall headwind for viewership, because if viewers are concerned about and questioning just where they need to watch. It's complicated. They're just going to end up going to the local restaurant. At least that's what
the bar.
They're going to be going to the bar to watch, because it's the only way they can find the true ability to guarantee they're going to be able to watch. Ali, great interview. Thanks so much for bringing that to us. We're going to have all of your markets action ahead right here, so stay tuned for more. You're watching Catalysts.
We've been discussing Apple's latest event all morning, and the reaction seems mixed. D.A. Davidson upgraded Apple and raised its price target on the back of the announcement. We had a chance to speak to the analyst behind that call, Gil Loria, earlier today. Here's what he had to say.
A lot of noise, a lot of people with different expectations coming in. But if you look at the signal away from the noise, you realize that this is unprecedented capabilities that Apple is going to introduce, and it's going to integrate AI into everyday life.
Meanwhile, Apple shareholder Ken Mahoney was a bit more muted in his reaction and predicted we may see a slight short-term downturn this summer. Take a listen.
Look, we're in this mix here. I've been telling investors we could hit a low with Apple over the summertime. As why would you want to upgrade your phone here? Why not wait for the 15 or the 16 and so forth? So we could hit a little low.
Interesting to see the varying reactions that we've had across Wall Street, across shareholders. But if you take a look at the share price right now, we are up more than 5%, surpassing an intraday high. Market cap at around $3.2 trillion. So at least right now, it seems like investors are digesting all of the announcements that we did get, and they're positive. Whereas last night, we saw the stock dip around 2%.
And this is so important. Apple is hitting new all-time highs today. And this is critical because this is a stock that just flipped into positive year-to-date territory in a matter of the last couple of weeks. You can see on that chart here, just happening in the month of June, Apple finally flipping into positive year-to-date territory. That was a huge issue for one of the big tech names, not just for Apple, of course, but for the broader market to have this much pressure on a $3 trillion company. As of today, because of the market moves to the upside that we're seeing, this stock up 9.5% year to date. So really a big turnaround story. That is exactly what Apple was hoping to do. And at least when you look at the stock price, they did deliver. It's interesting to see that the market reaction was negative after getting the news from the developers conference yesterday. So perhaps after seeing some of the consumer commentary off of that, also hearing some and seeing in some of the notes this morning that it was a little bit of a buy the rumor, sell the news. The kind of optimism around the stock was a little bit priced in. But looks like there's a lot more optimism to go for this stock.
We didn't even talk about the Genmoji announcement, how you can generate your own emoji. The millennial in me is very excited about this. The calculator on the iPad. There's a lot of features outside of AI that was announced as well.
Are you excited for the React too? I'm such a React girl.
Oh,
the
me
fact
too.
that I can be creative with my message reacts, I like.
Yeah, I want to have some fun. Like let's get it. I'm already anticipating the Genmojis my friends are going to be sending back and forth in our group chat. So
I love it. Allie and I, the key millennial sources, we will be driving the new trends of Apple replies when it comes to emojis. All right, everyone. Well, coming up here, we're going to have Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith has it for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, guess what? On today's show, Apple's big AI announcements. We're going to break down all the new features coming to an iPhone near you. We'll also lay out how the company plans to protect your privacy along the way. Plus, summer travel season, it's upon us, folks. We'll explain why traveling to Europe this summer might be pricey, and we'll ask an expert for tips to avoid going into debt when plotting your itinerary. Plus, saving for retirement. Are you married? Yes? Check. Are you working? No? Well, we'll explain how your spouse could set up a retirement savings account in your name. All that and much more during today's show, but let's take a look at some of the market action. We're 90 minutes into the start of today's trading activity as the Fed kicks off its two-day policy meeting about a half an hour ago. Stocks right now, they are mixed for the U.S. major averages. You're seeing the Nasdaq hold on to gains by about 0.2%. However, different picture for the Dow and the S&P 500. Down fractionally, the Dow lower by about 0.5% off of the session lows that we had seen. S&P 500, you're seeing that down by about 0.1%. Let's get to our top story this morning. It is, of course, Apple. After almost 2 years of essentially sitting out of the artificial intelligence frenzy, Apple finally made a big splash. The company announcing a slew of AI tools coming to its platforms. Shares are higher this morning and reversing some of the earlier losses that we had seen initially just after the announcements were made during Monday's session, down 2%. So let's get to Yahoo Finance's market domination co-host, Josh Lipton, who has the ultimate guide for all things Apple here. Hey, Josh.
All right, Brad. So I'm going to dig into 3 of the big features consumers are going to be able to take advantage of with Apple's new AI tools. Number 1, Brad, a brand new and improved Siri. Apple sees Siri clearly as your AI personal assistant. Customers can text Siri, and even more than that, with these new updates, Siri is expected to anticipate things a human would. For example, it can send the photos you want to your mom, or maybe find recipes for your dinner. Tonight, with the help of a little friend known as ChatGPT, but do not worry, it will ask your permission before including ChatGPT in your queries. Number 2, your notifications get an upgrade. Apple promises its new AI tool, new AI will put your most important notifications at the top. And wait for it, your group messages will be summarized. You no longer have to read 75 messages just to see how your friend's date went last night, Brad. And number 3, Apple will correct your writing, so the new AI tools will proofread, rewrite, summarize your notes, emails, pages, and a lot more. Integrated writing tools will also suggest responses in different tones for messages and emails. But there's a lot that Apple did not mention about these new tools as well. Company did not, for example, specifically say when the ChatGPT integration is going to arrive. It just said it will be before the end of the year. And of course, users will need powerful processors to make all this work. That means you're going to need an iPhone 15 Pro or Pro Max, or an iPad or Mac with that M series chip, Brad.
Well, look, I don't need any more summaries on how friends' dates are going. Judging by judging by all the weddings that I need to go to this year and the past few years, everybody better be done dating. All right, so all these things considered, it's going to be interesting too whether or not there's like a super cycle, consumer demand that comes forward as a result. You just mentioned the iPhones that people would have to have in order to make sure that the operating system actually supports some of these new features too. And it sounds like they're a little bit mixed on the street in terms of some of the initial reviews that we've seen coming out. I saw one earlier today that was looking at in UBS calling this, and they put Apple Intelligence in air quotes. I thought those were fighting words, but I'll leave that up to the street to spar on that too.
On the street, those are fighting words for sure, Brad. You're asking just the right question, because now, how do consumers actually feel about this, right? You got to test drive these features. Do they work as advertised? And then to your point, how many folks feel like, okay, I am really curious, I'm interested, it's enough for me to upgrade? You know, I had Paul Meeks on my show yesterday, so obviously Paul's been covering tech for a long time. He's been investing tech for a long time. I think Paul, and I've known Paul for a while, I think he was kind of cautious and skeptical about whether this really jumpstarts an upgrade cycle. I kind of push back on Paul, and I think maybe that what the bulls might say is, you know, I've seen estimates out there, Brad, that something like 40% of iPhone users are on a device that's more than 4 years old. In other words, there's a lot of old iPhones out there, and it might not take that much to get people to upgrade. If you just sprinkle a little AI features in there, I'll give you a new faster processor, you know, better camera, that's what we would all expect. come in the fall when Apple doesn't make that announcement in September. Is that enough to jumpstart a cycle? We'll find out.
As I check to see which model I have, I'm pretty sure I'm on the 12 Pro Max. So
it's time, Brad. Come on.
It feels like a personal attack here when they're saying, you guys need these new features. We're looking at you, Brad. Anyway, Josh, we're also watching the reactions from other billionaires out there. Elon Musk calling out Apple.
Some drama.
I mean, what's going on here? It's a new partnership with ChatGPT, and he wrote on X, formerly Twitter, that if Apple integrates OpenAI at the OS level, Apple devices will be banned at his companies. I mean, he's calling it an unacceptable security violation. So how is Apple protecting the data here?
Well, I think a couple points. One is Apple clearly yesterday, a big theme was privacy, right? That was clearly a theme they were hitting. I don't think that's too surprising. If you know Apple, you know that is a core value in Cupertino. Goes back to Steve Jobs. He used to hammer that as well. And that could be kind of a differentiator, right? I mean, they're clearly kind of set themselves apart from the competition. We know privacy, security, Brad, that's something Brad and Josh care a lot about.
We do.
With Elon specifically, I thought that was interesting because his reaction was very fast, very quick, very heated. And I don't know exactly what's going on there. I don't know, Brad, if maybe Elon just sees OpenAI in this point, and it's a little bit like, waving a red flag in front of a bull. There's just so much bad blood. Musk has sued OpenAI, which is a company he co-founded. So I don't know, that relationship obviously has gone completely south. Who knows, though, how that develops. I know they're kind of fighting words right now with Musk, but what's interesting is you don't know how that develops. Like, for example, Tim Cook now, listen, he's told you I got a partnership with Sam Altman and OpenAI, but you can foresee, as this progresses, you can imagine Apple has partnerships and relationships with all kinds of models. So it'd be OpenAI, maybe Google, maybe Anthropic, and why not Musk as well, who has his own AI startup, XAI.
Or one that just allows users to pick which AI they want to use. I mean, it's really just, to your point, it's just a potential starting point, and really seeing exactly where the uptick is from the amount of consumers that are either willing to pay in or want a free type of experience with so much of the generative AI, at least on the initial outset of what we're hearing, are going to be some of the features here.
I know another interesting question, which is when we talk about the partnerships that came out yesterday, we don't know what the economic relationship is between, let's say, Apple and OpenAI. How's that working? We don't know which way the money is flowing. Is Tim Cook sending a check to Sam Altman? Is Sam Altman sending one to Tim Cook? You could see it if Sam Altman knows, listen, I can't train my models on your data. If I'm not getting the data, maybe Altman thinks, well, at the very least, you can send me a check in the mail. But we don't know yet. I expect someone breaks that news at some point. How exactly the economics of this work?
Absolutely. Josh, fun chat to start off today's show. All things Apple here. Josh Lipton. You can catch him at 3 p.m. Market Domination. Turning now to the auto industry, General Motors approving a new $6 billion share repurchase program today. The company's CFO, Paul Jacobson, attributing the move to strong revenue growth, margins, and cash flow. Joining us live from Deutsche Bank's Global Auto Industry Conference in New York City, we have the man himself, General Motors Chief Financial Officer, Paul Jacobson, alongside Yahoo Finance's Pras Subramanian. Hey, Pras, take it away.
Hey, thanks, Brad. Yeah, here with the man, Paul Jacobson, GM CFO. He just announced, Brad, talking about that new $6 billion share repurchase plan. And this is on top of the $10 billion you guys did at the ASR at the end of last year. So what sort of what's the story here between GM and now there's a lot of cash return to shareholders?
Yeah, well, thanks for the time today. We're excited to be here at the conference and share the big news, which is we're continuing to lean into our capital allocation policy. And as the business has continued to perform and we've seen stable pricing, we've seen disciplined incentives from our team, and we've seen a vehicle portfolio that is customers just love. And all that spells a lot of success. So we're able to invest in the business, we're able to maintain a strong balance sheet, and we're able to return cash to shareholders. So we've completed that prior buyback authorization that we had done, and pleased to announce that the board has just authorized another $6 billion in share repurchases that will commence beginning in the second half of 2024.
Yeah, and you guys also boosted the dividend at the end of last year.
Yep.
So a lot of big news from a capital sort of return point of view. I think investors here at this Deutsche Bank conference happy to see that. But talk about the business too. What's sort of the evolution there going on right now as 2024 kind of the halfway point here? EV sales ramping up, ICE sales still strong. What's going on with the mix there exactly?
So, we've actually seen EV growth moderate a little bit this year for the industry, but GM's EV growth is outpacing everybody. We're picking up significant share. We sold over 9,500 EVs in North America last month. So seeing really strong gains in the Lyriq, in the Blazer. Really excited about the game-changing Equinox EV, which will be the lowest price 300-mile range vehicle on the market in the EV space. And that's just starting to now get momentum as we see going forward. So we're starting to execute really, really well in the EV space and seeing that ramp up. And the ICE portfolio with the new Traverse, the new Equinox, those vehicles, not only are customers really flocking to them, but they're also more profitable than the older models that they've replaced as well. So the business is really performing well.
You talk about cars like the GM, the Trax, a cheaper car that you guys can build affordably. What about that Equinox EV? That's going to be a mainstream EV. You guys are trying to target a profit metric at the end of this year. Is that still in play for EVs?
Yeah, so what we've said is, we expect to produce 200 to 300,000 EVs this year, and we can be variable profit positive. So this means that we can sell it for more than the cost of the materials and start to offset all of our fixed costs. We believe that we can be in that position in our whole EV fleet by the end of this year, and gating the way to become profitable on an EBIT basis in 2025 and beyond.
What about PHEVs and hybrids? I know the Corvette E-Ray's out there. We were talking about that earlier. It's a great car, amazing performance. But are we going to see that technology trickle down to the more entry-level cars? Or when are we going to see those EVs come out? Or
so
PHEVs
we've talked about adding a plug-in hybrid or a PHEV beginning in 2027. Mm-hmm. We see this as a pretty valuable tool for us to help bridge compliance against EV adoption. So for those customers who down the road aren't yet comfortable with EVs, a plug-in hybrid is a great option to sort of get that additional range extension, plus still have the backup of an ICE engine for road trips, et cetera. So we think that this can be a really good tool to help some of those skeptics bridge into EVs for the long term. But when you look at our portfolio of battery electric vehicles, it's really is compelling what we're able to offer in terms of style, range, and capability.
And have the kind of capability to sort of augment that with PHEVs and hybrids down the line. Looking big picture at the business, we're at the conference here. We're going to be talking to some investors shortly about that. What are some of the kind of key highlights you want to note for 2024 and beyond, and sort of like your adjusted EBIT kind of targets, things like that?
Yeah, so we came out at the beginning of the year and talked about 12 to 14 billion dollars of EBIT, and we were able to raise that guidance at the end of the first quarter based on the outperformance. And the business is continuing to perform very, very consistently for us. So we've always taken a very sort of stable view in terms of what we're trying to do with incentives, with inventory levels, and the team's been really strong at executing that. And the vehicles, customers love them, and that's where it all starts. If you don't build products that customers want, then the big business becomes much, much more challenging to run. But our design team, our engineering team has created a portfolio of vehicles that customers just adore.
Well, the customers, so the U.S. customers in particular, we hear a lot about they're doing well, they're not doing well, prices are high. What's sort of your 500-foot or 30,000-foot view of the U.S. customer for GM? What are they telling you guys?
Our customers have responded really well, and they've maintained that strength. Many times when you're looking at full-size trucks, full-size SUVs, we're still seeing people adopt premium trim levels, and that business has been strong. But you look at the resiliency of our portfolio all the way down to the Chevy Trax that you mentioned. I mean, this is an incredible vehicle that starts at $20,000. So that's, I think, one of the keys to GM's success is that portfolio that has something for everybody across all of the different price points that they might be looking for.
That Trax doesn't look like a $20,000 car. It's got that nice aggressive look, but
I just got my daughter one.
Oh, did you?
Yeah,
right.
my daughter needed a car to drive around LA, and she's driving around a new Chevy Trax and loves it.
You're getting that nice light blue color. It's not bad. So, Paul Jacobson, thank you so much for joining us. GM again with the new buyback plan here at the Deutsche Bank Global Autos Conference. More Yahoo Finance after this.
Financial independence can be a lifelong process, and unless you win the lottery, and if you do, hit up a brother, it's good to have a plan to build your wealth throughout your life. Joining me now to discuss how women of all ages can plan for their financial independence, we've got Regina McCann-Hess, Forge Management President and author of Superwoman Wealth, here in the flesh, in studio with us. Regina, great to see you.
Thank you for having me.
Absolutely. Let's dive right in. I mean, we're talking about different generations who have experienced different economic cycles, different costs of living. So where do we even begin here, and what are you seeing being successfully deployed as a strategy right now?
Well, I think the younger generation actually, I think, is doing a little bit better job than I did in my generation, because I think with social media, there's a lot more information out there, and they're getting married later, so they're keeping separate accounts for the most part, not all the time, but I think that actually helps women stay a little bit more in tune with what's going on.
What are some of the biggest pitfalls that you see, and how can people make sure, women make sure that they don't kind of fall into some of those same traps?
Yeah, I think it starts when you're starting out. You know, you come out as a young adult, and nobody teaches you financial adulting. So if you start out on a good foot, you'll probably stay even keel and make good habits early will follow you through.
When we think about, and we're looking at some of the tips here for women ages 25 plus here, emergency funds are something that we talk about frequently on this show, and how you kind of strike a good balance between having an emergency fund and having the right amount of savings and putting away for retirement here. Is there a good kind of rule of thumb percentage-wise that people should be keeping in mind?
Yeah, I think about 20, there's like a 50, 30, 20 rule with budgeting. I mean, there's a couple different rules, but that's the one that most people go by. And then, so if you can save 30% or even 20%, honestly, those are goals. Whatever you do is going to help you. Just do the best you can, because it's progress over perfection.
Now, let's say you're a little bit closer to retirement age, and you're saying, you know what, by 3 months out from now, I'm knocking on retirement's door and I'm getting out this office. Then what? How do you kind of go about that calculus?
Yeah, then you're piling money into your plan, and hopefully you do it a couple years before that. Once you turn 50, you're eligible for what they call catch-up contributions, and most people at that age are seeing that retirement door opening, and they're like, okay, yes, I'm putting as much money as I can. So that's one of the things that they can do.
Now, what if you fall right in between this? This is the forgotten generation often, and as we're thinking about, all right, not necessarily being fresh to the workforce or perhaps a few years of experience and not knocking on the door of retirement, but right dab smack in the middle here.
Yeah.
What should be the mindset?
Sometimes it's good to go back to the basics. I know, with COVID and then that super inflation that we've had, all of us have probably had to step back and say, whoa, I haven't had a budget in a long time, but I think I need to now because everything's so expensive. So that's a great space to do that. The other thing that would be really good there is think about the lifestyle creep. And that's like, as you make more money, you tend to spend more money. So there you could say, okay, as I make more money, I'm going to do the 1/3 rule. With every new raise or bonus, I'm going to put 1/3 towards my rainy day savings, 1/3 towards increasing my retirement savings, and then the other third, okay, I'm going to spend that and put it into my cash flow, but not the whole raise.
A lot of this comes back to earnings as well. I mean, we are still seeing a considerable gap between earnings and the gender pay equity as well here. Where can women and where can workplaces also do their job in making sure that we are closing that so that those savings go a little bit longer as well?
Yeah, I wish I had the answer to that, because when I came into the financial industry over 25 years ago, it was still 82 cents on the dollar as that men make, and it's still 82 cents on the dollar. So that we haven't really moved the needle on. But there's also an issue because women step out of the workforce for at least 12 years during their working career, either to take care of their children or their ailing adult family members, and they lose those pay raises, those promotions, and all those years of putting towards their retirement funds.
All right, Regina, we got to leave things there for today. A lot of work still to be done, but thank you so much for some actionable tips here that people can put into practice. Appreciate it.
Thank you.
Absolutely. It's Regina McCann-Hess, Forge Management President and author of Superwoman Wealth. There you're seeing the book cover right on your screen there, folks. Coming up, summer travel season just getting started, and we may have some money-saving tips on the other side of the short break and much-needed information that could impact your vacation plans. That's next on Wealth. Travel to Europe is the most popular international destination for consumers this summer. That's according to data from Hopper. But the price for that dream trip on the French Riviera, parlez-vous français, is about to get more expensive. Our very own Madison Mills is over at the big board, and she's going to break down why. Hey, Maddie.
Hey, Brad. So I know we don't love to talk about currencies, but in this particular case, the euro dollar is going to be a big driver of why your European travels this summer might not be as affordable as they were previously. So I want to pull up the euro dollar. You can see moving to the downside on the day here at 107. That means that it's going to be a less favorable exchange rate for travelers. I just want to pull up one specific example here. A 500 euro hotel room is going to equate to about 550 US dollars right now. So obviously that is not going to be favorable for travelers. Also because of just general inflation that we're seeing, you're seeing that some of the experiences like entrance to the Eiffel Tower that you mentioned, Brad, that's going to be up about 20% compared to last year. You can see again that hotel room rates are increasing by about 10%. That is according to reporting from Hotel Monitor. Now there are some opportunities in the space for travelers, particularly when it comes to something like airfare. Airfare has decreased for travelers over the course of the past year here. We're seeing that average airfare from the US to Europe is around $8.92. That is down 16% year over year. So as long as you can make it there, that is at least one area of cost savings. Also, some experts saying that if you're willing to look outside of city centers, particularly in a place like London, in France, for example, you might be able to see better opportunity. And in France in particular, you've got the Olympics coming up this summer. That actually can lead to a little bit of a decrease in tourism to cities. People tend to avoid them during those big tentpole events. So you could see some price favorability around that event as well. And also another final tip, look for some of those hotels that are going to have a lower star rating. Those higher star rating hotels have so much demand from the pent up travel demand that we're seeing overall in the space. That is giving them the ability to increase those prices. So maybe take on a little bit less of a fancy hotel for yourself so that you can afford that trip abroad, Brad.
All right, thank you very much, Maddie Mill. Merci beaucoup, mon ami. Thanks, appreciate it. All right, let's stay with the traveling theme. Well, TSA, they're preparing for the busiest summer travel season ever. And according to Hopper, 87% of their users plan to take a trip this summer, with 13 million of those travelers heading to Europe. The Paris Olympics, one of the big draws for travelers this summer. So what are we seeing in the U.S. to Paris travel this year? Joining us now with the insight into summer travel trends, we've got Christian Vernet, who is the CEO of La Compagnie. Great to have you here with us today. It's a business class airline operating regularly scheduled transatlantic flights between New York and Europe here. Break down the trends that you're seeing for us and the demand, especially for business travel, to some of the routes that you go to.
So for this year, for the summer 24, globally our load factor seems to be very well oriented. We are going to reach at least 90% load factor for the summer, which is a representation of a very good year. So demand to Europe is very strong in the US, and it has been strong since the outset of COVID, 2022. Travel revenge was the first exercise where we have seen massive amount of passengers flying back to Europe. 2023 was a bit similar, and 2024, with the Olympics, which is somehow of a dynamic factor for Paris route in particular, we do see very significant demand.
Okay, so with that in mind, I mean, you're primarily focused on that business class experience here. So as you're thinking about the type of traveler that's flying with La Compagnie, where are you expecting to see these trends remain intact over the longer term?
Well, if you talk about the summertime, it's essentially leisure traveler, including in the business class travel that we have. We are full business class airline. Obviously, the corporate travel is a bit different and occurs at different periods of the time. What we see, the tendency is that the trend is that the leisure travel is very strong. It is keeping stronger than it was in 2019, for instance. The corporate travel is not as significant, as strong as it was pre-COVID for sure. I believe that it's going to take another 2-3 years before we get to the pre-pandemic factors. But globally, we see an overall business travel demand very, very significantly higher than it was before, which is good news for the industry. It's good news for the economy in general. And well, we do everything we may to serve that excursion into demand.
I mean, look, this looks like a very swanky excursion here. I'm taking a look at the interiors of the plane itself. I believe this is the A321 Neos that you're operating, yes?
It is exactly, yes.
Okay, all right, so excellent there. When we think about the expansion plans, what's that look like for the business?
Well, for time being, we only have 2 airplanes flying from New York to Paris, Nice, and Milan. And we are currently these days working at securing a 3rd airplane, and more to come after that from 2026. It's a bit remote, I must admit, but that's the dynamic of the aircraft manufacturing industry, which is a bit a difficulty at this time. But we want to add more capacity because what we offer to the public is very highly demanded. And like you've seen on the screen now, we do offer a very specific welcoming environment for passengers, and they do like it very much. So demand is picking up, and our goal is to serve that as best as we can for the years to come.
You mentioned the difficulty of the aircraft manufacturing equation right now, and I wonder, from your seat, the pulse of CEOs as they think about the orders that they're making, either with Airbus or Boeing, given some of those difficulties right now.
Yes. Well, I mentioned the time to get an airplane. I mean, I remember back in late 17, it took me 14 months to get the first A321neo airplane. Today, it is required to me to provide at least 2 years and more to get an airplane. And that situation has not evolved in a favorable manner over the last couple of months. And it is expected that the Boeing and Airbus production level will not be able to capture with the increase in level of demand that IATA sees for the years to come. So we are facing some potential difficult times as far as supply of airplanes is concerned.
Yeah, we actually were breaking down some of what IATA had just put out in their own trends and expectations for the next few years, just a few weeks back, I believe that was. As you think about the way the consumer is looking like they want to spend on travel, what should we expect in terms of price moderation?
Well, price depends a lot on competition and the supply of seats. In the routes that we serve, and I must say it's different according to different markets that are to be looked at. On the routes we serve, competition is very intense. So the pressure to keep prices down is very significant. And for instance, frankly, from Paris to New York in business class, for instance, the prices that you get in 24 are less than the one you got in 23. So that's good for the consumer, but that's good in general from competition. Competition is putting prices down and quality high, yet there is a limit to that because obviously the escalation that we get from resources, airplanes, fuel, services, airport services, and others are putting the pressure on the profitability of the airline. So at one point of time, we may have some small hikes into the prices. But globally, we are all working hard to improve our efficiencies and make sure that we can offer the same level of service even better at the same price or even better price in the future.
Christian Vernet, who is the CEO of the company, thank you so much for taking the time here today. Great to see you. Well, if you, like millions of others, are planning to travel this summer, how do you do so without breaking the bank? Joining me now, we've got Jen Ruiz, who is a travel expert and author of the new book, 12 Trips in 12 Months. Wait a minute. 12 trips in 12 months. I mean, we're going to break down where you went. But people need the tips in order to navigate this summer travel season. Where do they start? What's rule number one?
I think rule number one is never waste a purchase that you're making. So many people are already buying things online. They're already paying with a credit card. You should be getting some kind of points or miles for every purchase. So particularly if you link, for instance, I took Lyft to get here this morning. Yeah. I got airline miles for that Lyft purchase just by linking my accounts. So I think anybody, even if you don't have a travel credit card, can be getting points and miles for these online purchases.
Okay, and so with that in mind, where are you seeing, and we're gonna get into your 12 trips, because I imagine a lot of other people are trying to make the same decisions on how to plot out their trips as well. What are the no-nos, if you will, the thing that you should be looking out for as you're starting your trip planning?
Well, you mentioned European travel being the most popular place for the summer. I probably would avoid going to Europe this summer and find somewhere that is off-season where you can get better deals. The Southern Hemisphere, South Africa, New Zealand, Argentina, this is their off-season right now. So you can actually find much better deals with less crowds and probably have a more enjoyable experience than you would peak season Europe, Rome.
Interesting. I believe we have a full screen as well, because you broke this down very well in terms of the do this and don't do this.
Yes.
So I want to run through a few of those things, and it starts where people are booking too, and talking about some of the deal sites there. How can you navigate what is a trove of listings that are going to come forward when you start that search and put in the date and times that you want to travel?
It can be so overwhelming, right? And you get so many alerts, so many notifications. I would say pick one program that you know has good deals going from your airport. There are a lot of flight alert sites that will send you an email and they'll say, hey, there's a $99 flight to Paris. Do you want to book? Click here. And that's really a great way for people who are beginner deal hunters to find deals and just click to book.
What about activities? I mean, you got to do something when you get somewhere. So how do you make sure that you're having fun on this trip that you're taking, theoretically, and then you're not breaking the bank along the way?
You should absolutely plan ahead. It doesn't only save you money, but also time. If you get a ticket in advance, you may save yourself an hour for waiting outside of that museum to get the ticket to go in, and you'll probably save at least 10%. Look for things like free walking tours that are available in most cities. Look for free or reduced museum admission prices, and plan your visits around those deals.
I need some splurge calculus, if you will. When does it make sense to be, perhaps a little bit more leisure about how much you are spending into an experience?
I think that it really depends on the person, but for me, the whole point of traveling is to have a memorable experience. So whether you want to splurge on a food dish that you want to get something spectacular, go to a Michelin star restaurant, or you want to have a fancier experience. For instance, I flew in here today in New York on a helicopter from Newark, and on the way, we also flew over the Statue of Liberty.
You took a chopper here?
I really did.
Oh my goodness. Okay, good experience?
It is. It's a shared ride service, so
Okay.
you're splitting the cost of it, and you get that sightseeing tour on the way. I mean, there's no better view of the Statue of Liberty than from above, and you get into the city in 5 minutes as opposed to an hour.
You're living like a queen right now. All right, Jen, I got to know, just as we're about to let you go, what was the top trip? 12 trips, 12 months. Title of your book. What was the top one that you took?
Well, Europe is popular for a reason,
Yeah.
so I have to say that the south of France in peak season is quite unlike anything else. The lavender fields, the sunflower, the Van Gogh art, that you can see the real-life places that he painted. It's really quite lovely. So that was a very memorable trip just by virtue of being so peaceful.
All right. The Queen, Jen Ruiz, who is a travel expert and author of the new book, 12 Trips in 12 Months. Thanks so much for coming in studio via chopper, no less. Not too shabby. Coming up, everyone, how you can set you and your spouse's retirement up for success. We'll break down how a spousal IRA might be for you. That's after the break. Stick with us.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
tax break that might help some single-income married couples, and it's called a spousal individual retirement account. And it allows a working spouse to contribute to an IRA in the name of a non-working spouse with little to no income. And that helps lower the tax burden on the income earner. To break down if this is right for you, we've got Cassandra Rupp, who is the Vanguard Senior Wealth Advisor, here with us. Great to see you. Thanks for hopping on. This is an important topic for many who are single income households and trying to make sure that both partners can plan for retirement here. So where does the conversation need to start? Is this something you go to your employer and say, okay, I want to set this up, or is there a different firm that you work with on your retirement account that you need to reach out to first?
It's a great question. So it's separate from your retirement savings, say in your 401k that's sponsored by your employer. This would be in an individual retirement account that you can open at any financial institution. It's just going to be under your name. It's not going to reference your spouse's name or be a joint account. It's independent to you, but it's, like you stated, funded with your spouse's income if you're the non-working spouse.
What are the pros? And then maybe on the other side, what are some of the cons of this?
Yeah, I'd say there's not necessarily cons to the type of account being a spousal. And when we talk about pros and cons, we're really looking at the differences between a traditional IRA and a Roth IRA, which would be the two options that you could open. And that comes down to a broader conversation of what does your tax situation look like now versus how it may look in the future. There's going to be different tax benefits for each type of account.
Certainly. What are some of the other retirement or planning that you can do in a single income household to really set up for retirement?
I think it's all about a joint conversation between you and your spouse. Maybe only one of you has that employer-sponsored plan. Maybe both of you now have IRAs if you can utilize the spousal IRA benefit. But otherwise, all other investment accounts that are not retirement planning vehicles can still be used for that long-term planning. So it's just a discussion with someone like myself as a financial advisor, where should every additional dollar go? And then we'll help you navigate how to formulate a plan that you're comfortable following for retirement.
I mean, and that's a great point as well. I mean, what is the delta between doing this and not setting up a spousal IRA if you were able to, essentially?
Every dollar matters. I think whether it's a spousal IRA, which has the tax benefits, a huge perk, or it's another general savings vehicle, I think every single dollar that you can put away towards your future is impactful. I'd caveat that, I want someone to have emergency savings. I want them to be covered in the short term before we start even exploring retirement options. But once you've had those open conversations and you've made a plan, then I think you can prioritize again where these savings are going to be.
And then at what point can you draw upon this account?
There's going to be some nuances between the traditional and Roth IRAs, some flexibility for earlier withdrawals, but their intended use is going to be after age 59 and a half, where you're withdrawing tax and penalty free for the Roth IRA and withdrawing from the traditional IRA, but having to pay that income tax. So you want to make sure that those savings are something that you can envision keeping in that account for a long term. There are some ways to access before that if we run into special circumstances.
Cassandra Rupp, who is the Vanguard Senior Wealth Advisor here. Thanks so much for taking the time today. Really appreciate it.
Thank you.
Coming up, new data about how optimistic small business owners are feeling in this economy. We'll explain more once we're back from the break. See you soon.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
How are small business owners feeling about the state of the economy? Big question. And one piece of data that analysts look at is the Small Business Optimism Index, which comes out monthly from the National Federation of Independent Businesses. The latest numbers are out this morning, showing optimism among small businesses is up 0.8% from last month. So what do these numbers actually mean for you? To help explain everything, we've got our very own Rochelle Akufo. Hey, Rochelle.
Hey, Brad. So as you mentioned there, the NFIB Optimism Index did tick up to 90.5 in May. That's marking the second consecutive month of improvement. But to give some context here, it's still below the historical average of 98 that was last seen of December of 2021. Now, this index actually measures 10 key aspects of business operations and sentiment. So in terms of the single biggest concerns, no surprise, inflation topping the list there with 22% of them concerned. That is down from 3% from a year ago, but of course, don't celebrate too early at that big number. NFIB Chief Economist Bill Dunkelberg noted that, quote, for 29 consecutive months, small business owners have expressed historically low optimism, and their views about future business conditions are at the worst levels seen in 50 years. Small business owners need relief as inflation has not eased much on Main Street. So talking about that disconnect there. Other concerns include quality of labor, that's the next highest, followed by taxes, cost of labor, and government regulation, Brad.
Yeah, so what are small businesses most optimistic about here?
So as we dig into this data, we are seeing a slightly narrower difference between the hardest and the softest parts of the small business optimism outlook, which is why we did see the number tick up overall. So more optimism in expected business conditions, the outlook for expansion, expected real sales, expected credit conditions, and inventory satisfaction. On the tougher side, though, seeing more hardness when it comes to job creation plans, job openings, inventory plans, earnings, and capital expenditure plans, which of course also ties into the job number that we see. So we're seeing a lot of small businesses concerned about really filling these labor holes.
And so how can investors perhaps use this data to inform their decisions too, Rochelle?
So it's really getting a temperature take here. So you have this dynamic of cautious optimism in some regards and lingering challenges. So investors should really focus on these sectors with strong pricing power and those poised to benefit from this improved economic condition that we're seeing, as well as some of these easing credit constraints for small businesses. But of course, just a note, use this as part of the overall economic picture. We have a slew of other data coming out just this week, including the third announcement. And keep in mind, we're also in an election year. So we know that we're going to hear a lot of politicians targeting these concerns. And the NFIB report actually notes that the election promises to bring major taxes in the tax and regulatory environment, regardless of who wins. All of this presents a very uncertain outlook for small business owners, and uncertainty is the enemy of progress. So a bit of a dire warning there, even though we did overall see that optimism index tick up there, Brad.
Yeah, it's really interesting. A lot of the data breakdown that we've been watching within this index and just where things have been shifting for the optimism for small businesses here, especially given what we've seen in a few different elements of the economy. I mean, you touched on inflation. We just saw the jobs report last week as well here, and it gives us a sense of where some of the small businesses are navigating, where customers are still in engagement on price, but then also what they're having to pay for labor as well right now. So a lot of things that they certainly are kind of towing the line on right now, Rochelle, it seems.
Indeed, and especially you mentioned some of the stickier areas there. Retail, still seeing a lot of price hikes there that they're still trying to contend with, these small businesses. So we'll continue to watch that data, Brad.
All right, Rochelle, excellent breakdown there. Thanks so much, Yahoo Finance's own Rochelle Akufo. And let's do a final check of the markets as we're taking a look at the major averages here on this day one of Fed meetings. FOMC, they are actively behind closed doors trying to figure out when potentially those rate cuts are going to come forward. Guess what? Probably won't be this meeting. At least that's what the CME FedWatch indicator is telling us right now. But taking a look at the markets right now, they are lower across the board. Dow down by about 0.5%. S&P 500, that's down by about 0.3%. Nasdaq Composite, you're seeing that drift into negative territory. It was positive when we started off the hour. We'll keep a close eye on that. And of course, all things Apple, just one of the components within the Nasdaq, the S&P 500, and the Dow. As we are rounding out this show, that's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You can stay tuned. We've got Market Domination coming up 3 p.m. Eastern Time with Julie Hyman and Josh Lipton. You do not want to miss it.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.